Hello aspirants, we are having a banking awareness course which is a one-stop solution for the banking awareness as it covers both current and static banking. If you see under the current banking, there is weekly banking video which covers that week's banking and finance part, and the monthly banking PDF which consolidates the entire month banking and finance news in this particular PDF. Both can be accessed under this current banking part. And under the static banking part, if you see, this covers the static concepts which forms the base for the current banking news. So here in-depth explanation of the topics with examples will be provided, and also you can watch the videos for more understanding, and after reading the notes and watching the videos you can attend the quiz in the form of a revision. And also if you see, we regularly update the topics under the static banking. So the latest information will be available under the static banking. And also if you have any doubts, we also have a doubt solving section where you can post your doubts and our team will quickly resolve all your doubts. So before purchasing this course, you can avail this RS10 code for an extra 10% discount. Today we will be covering Reserve Bank of India Part 5. This will be the final part of Reserve Bank of India topic, and this part is very important because we are going to cover a few important topics like regulation of the bank, supervision of the bank. So these kind of important topics are going to be covered under this part. So first, if you see the most important function, obviously even other functions are very important. So one of the other important function of the RBI is regulation and supervision of the banks. So here if you see, they regulate and supervise the banks. So what is regulation? Why should the RBI regulate and supervise the bank? Why is that function very important? See, majorly what is the function of a bank? They collect deposits from the depositors and provide loans to the borrowers. This is the main traditional function of the banks, right? There are other more functions, but the first and the most important function is collecting deposits, and then using that deposit they provide loans to the borrowers. You know, during this time what happens is that they will give short-term deposits. There might be times where the banks may use short-term deposits to provide long-term loans. Say suppose there is a deposit which matures in 1 year. Using that money, they might provide 5-year tenure loan. Okay. So what is this called? This is called a time mismatch. Okay. So what happens after 1 year, if the person comes and asks money, and if the bank is not able to provide the money to that depositor, then it will be in a very tight and liquid position. So whenever the depositors come and ask the money, bank should be in a position to give the money. Okay, there will be a time mismatch. A liquidity mismatch will always happen because sometimes banks may have to use the short-term deposit to fund their long-term loans. So how much can they use their short-term deposits? How much money of short-term deposits can be used to provide long-term loans? All this is governed by the Reserve Bank of India. All this is regulated. How much it can be used, all the numbers have been provided by the Reserve Bank of India so that the bank do not enter into a bank run kind of situation. What happens? What does bank run mean? See, what does bank run mean? Bank run is a situation where the people lose trust in the banks and everyone together they come and try to withdraw money from the banks. When a lot of people who have deposited money come and try to withdraw money from the bank, will the bank be able to provide the fund? So this is the bank, this is what is called as a bank run situation. So to avoid that situation, the bank should be properly governed, should be properly regulated and supervised. That is the primary job of Reserve Bank of India. So they will design a proper regulatory framework. That framework should be followed by each and every bank. So why this has to be followed? This has to be followed in order to maintain the soundness and stability of the financial system. So if the financial system, if the banking system has to be stable, then they have to follow diligently the regulatory framework designed by the Reserve Bank of India. So if you see, who all should follow? See, it is we will tell all. So these are the following banks that have to follow the RBI regulation. So the commercial banks can be broadly classified into public sector banks and private sector banks, and public sector banks are further classified into State Bank of India, Nationalized Bank and RRB. So Nationalized Bank are nothing but Punjab National Bank, then Indian Bank. So all this comes under the Nationalized Bank. And RRB we know, right? So RRB unique thing is that you have to know the ownership structure. Okay, under the ownership structure, if you see central government, state government, and the sponsor bank. So central government will own 50%, state government 15%, and here sponsor bank 35%. This is the ownership structure of the RRB. And one more unique feature of this regional rural bank is that this is regulated by RBI, but supervised by NABARD. This is what is a unique feature about this. For the other banks and all, for SBI, nationalized banks, even for the private sector banks, both regulation and supervision is by the Reserve Bank of India, but only in the case of regional rural banks, regulated by the Reserve Bank of India, but supervised by NABARD. And similarly, the private sector banks, they are further classified into domestic and the foreign banks. Okay, so foreign banks means the headquarters is outside the country. Domestic here means the headquarters is here inside the country only. That is what is the difference between domestic and the foreign banks. So under the domestic, you have universal and differentiated and local area bank. So differentiated, you have two types. One is payment bank, the other is small finance bank. So we know that the payment banks, they cannot provide any loans. Okay, they cannot provide any loans. So main function of them is they provide remittance facilities for especially the underserved people and all. Okay, especially the migrant people. So for them and all, the remittance services are mainly provided. They cannot provide loans. This is the main unique thing about payment banks. So generally, if you think the bank purpose is what, getting money from the people and giving money to the people, right? But here payment banks, they cannot give money. They can only get money from the people. They cannot provide any loans. This is a unique feature of payment bank. And here small finance bank, we know that this is specially to serve the underserved, the small finance, the small business people, the small and marginal farmer people. So for them especially, this bank was launched. Okay, so this is the overall structure of the commercial bank. Okay, so all these banks are regulated by the Reserve Bank of India and also supervised by the Reserve Bank of India, except for RRB, which is supervised by NABARD. This is a very, very important point. So what regulation, what does regulation mean? So regulation, it means that it provides license. See, if any entity wants to become a bank, then it has to submit the request to the RBI. Okay, RBI sets the guidelines that what all criteria you should meet if you want to become a bank. Okay, so the entity should ensure that the entity should ensure that it has met all the criteria. Only after ensuring, it will submit the application to the Reserve Bank of India, and after the Reserve Bank of India follows the due diligence process, it will either accept or reject the license accordingly. So Reserve Bank of India sets the criteria for any bank, for any entity to become a bank, and also the entity should request for the license to the Reserve Bank of India. Not just banks, even NBFC, even the payment aggregator, everyone, if they want to become one, then they have to submit the license to the RBI. RBI is the final regulatory body which can provide the license to those entities. Similarly, RBI also sets the minimum statutory requirement. The minimum statutory requirement like CRR, that is cash reserve ratio, then SLR, that is statutory liquidity ratio, that is a percentage of the deposits has to be maintained in the form of cash, and a percentage of deposit has to be maintained in the form of cash or gold or the government securities. So this and all, no, this all is being set by the Reserve Bank of India, and the value of it also keeps on be changing, and that is also set by the Reserve Bank of India. Next is the ownership. We know that the public sector banks are majorly, they are owned by the government, right? So major shareholding is the government. The private sector bank, major shareholding is the promoter and the people. Okay. So here, if you see in the public sector or the private sector bank, if any entity or an individual wants to own a share of 5%, then it has to get approval from, or it has to notify or get approval from the Reserve Bank of India. Say suppose you are holding 4.5% share. Okay, this is for an example I'm telling. Say there is an entity X that has been holding 4.5%. In future, it wants to buy 0.6%. Then the overall shareholding will increase to 5.1%, right? So that time it has to get approval from the Reserve Bank of India. So if any entity or individual wants to own more than 5% in either public sector or private sector bank, they have to get approval from the Reserve Bank of India, because Reserve Bank of India keeps control over the ownership also. So it has to be aware of the ownership of the public sector or the private sector banks. So these are the various regulatory functions. We will see even more in the upcoming slides. Next, we are going to discuss about IRAC. IRAC is Income Recognition and Asset Classification and Provisioning Norms. It is for the purpose of asset quality, in order to maintain the asset quality within the banks. Okay. So if you see, this was introduced in lines with the international norms. So RBI has issued guidelines on this IRAC to ensure greater consistency and transparency in the financial statement. Basically, here if you see, when is the income recognized? Okay, when it is credited, right? See, when an account, what is the profit for the bank? The interest that the bank get from the loan that they provide. Okay, so when the loan is, when the repayment is done, then only the actual payment is done, right? So this, if you see, the actual payment happens. That is, the money is transferred from the customer's account to the loan account. Okay, but there is also something called NPA, right? What is NPA? NPA is a non-performing asset. Okay, so here if you see here, the interest, it is an accrual basis. That is, the actual payment is not done. The NPA, what happens in NPA? Around for 3 months, that is for 90 days, the principal and the interest, it is not being paid by the customer, then that loan account turns into an NPA. So if you see, the interest and the principal, it is accrued, but the repayment is not done. That is, the actual payment is not done. Here if you see, the income is not recognized because this is only on an accrual basis. That is, the interest is booked, okay, but the payment has not been done. In the case of a standard asset, the actual payment happens. So that in that standard asset, the income is recognized. In this case of NP and all, the income is not recognized. That is what this income recognition means, and asset classification. So based on, as I said, if the payment is proper, then it is called a standard asset. When the payment is not done, it is called as an NPA. And also there is something called SMA 1, 2 and all, which means that we know that in NPA, when the payment is not done for 90 days, then that account turns into NPA, right? In SMA 1, 2 and all, if the payment is not done for 30 days, if the payment is not done for 60 days, so if the overdue is for 30 days or 60 days, then that will be classified under SMA 1, SMA 2 category on. This we will discuss in detail in the NPA chapter. Okay, you don't have to worry now what is SMA 1, 2 and 3. That and all we will discuss in detail in the NPA chapter. For now, you remember that there is something called as asset classification, depending upon whether it is a standard asset. If it is not a standard asset, if the due payment, if the overdue is for more than 1 day or more than 30 days or more than 60 days, then they are classified as SMA 0, 1 and 2. And if the overdue is for more than 90 days, then it is classified as an NPA, that is non-performing asset, that is it does not give any income to the bank. Okay, and next is provisioning norms. See, we know that when a loss occurs or any NPA and all, you have to provision. What does provision mean? Provision means the bank has to keep some amount aside from the profit in order to provision the NPAs. Okay, if the NPAs keep piling up, a provisioning should be done. Okay, this is for the entire stability of the banking system. This provisioning norms were introduced. Okay, to ensure that the loss asset or the NPA assets, they are provisioned. And the provisioning, how will it take place? Bank will remove the money from the profit and allocate it for the NPAs. This is what is called as provisioning. Okay, so this IRAC norms was introduced again by the RBI in line with the international norms to ensure transparency and stability in the banking system. Previously, we saw CRR, SLR, and now we have seen the IRAC norms. Next is Basel guidelines on the capital and liquidity. So, we have discussed Basel norms in detail in the chapter called Important Committee, Part 1. In that, we have discussed Basel norms in detail. So, I will just brush it up now. Okay. So, if you see Basel 1, Basel 2 and Basel 3, you know that there are 3 Basel norms. First, Basel 1 was introduced. Okay, in that if you see, only the credit risk was addressed. There is only one type of risk was addressed, that is credit risk. What does credit risk means? It means that if the borrower who has borrowed the money fails to repay. So that is the credit risk. That is the risk. That risk is called as credit risk, and that is associated with any banking. Okay, and even in the Basel norm, this capital adequacy ratio concept was introduced. And then only RBI has instructed the bank to keep a capital adequate of 9%. So as per Basel norms, it is enough to keep a capital adequacy ratio of 8%. But as per RBI, the banks in India, they have to maintain a capital adequacy ratio of 9%. Next, in Basel 2, if you see, apart from the credit risk, 2 more risks were involved. That is called as the market risk and the operational risk. What is this market risk and operational risk? Market risk is that we know that apart from giving loans to the customers or the borrowers, the banks also invest in the market. Okay, so in the stocks, in the bonds, they also make an investment. So what happens if the stocks go down or the bonds go down? So that is the risk that is associated with this market investments. Next, operational risk. It involves, like, we know that operations to run the bank, what people are there, systems, that is computer are involved. What if the system is compromised? What if a virus attack happens? What if the people or the staff has done some erroneous upload or erroneous transfer? So this is called as the operation risk. So even these kind of risks are there, right? So these risks were introduced in the Basel II norms. Remember, in the Basel I only credit risk were there. In Basel II, the market and the operation risk was added. Next important point in the Basel III, right? Apart from that, few other things also happen in Basel II, but I don't not want to get in detail because it'll again be like repeating, okay? Because everything in detail has been covered in important committee part 1. So that is why I don't want to repeat all the things here. I'm just telling few important things. And Basel III, two main things was introduced. One is LCR, that is liquidity coverage ratio. So what is liquidity coverage ratio? This is to ensure that the banks have enough high quality liquid assets to ensure that it covers the net cash outflows, that is whatever money is expected to move out of the bank in the next 30 days. Okay, this is ensure that the banks have enough high quality liquid assets that is enough to cover the net cash outflow over the next 30 days. Okay, this is to ensure, that is the purpose of this liquidity coverage ratio. Similarly, one more thing was introduced, that is NSFR, this net stable funding ratio. So this is to ensure that the banks have enough fund for a long term. So LCR is for the short term and NSFR is for the long term. So these are the main two terms that was introduced in the Basel III norms. I hope you have understood. And if you want to know about this, if you want to know about this Basel norms in detail, please go and watch this important committee 1. Next is counter-cyclical capital buffer. Now, what is this counter-cyclical capital buffer? This is to build a buffer of capital in good times. See what happens in good time. In good time, that the bank have lot of money. Okay, and also people take their payment on a regular basis. So which means lesser number of NPA, more number of capital with the bank, more profit, because lesser number of NPA means lesser number of provisioning also, right? So which means that more profit or more capital is there with the bank to lend. When there's more money or more capital with the bank, what they prefer to do? They prefer to lend more, right? So because instead of having idle capital in your hand, instead of having idle money in your hand, it is better to lend it and get interest in return. So here what they're telling is that instead of lending more money, when you have more money in your hand during good times, instead of lending all the money to the people, you have to start building buffer so that you save it in time when you actually need it. When the economy is very down, or when the repayment is not properly done by the customers, then you need a lot of money. Okay, so that is why during good times, do not give all the money to the people. Start storing buffers for the horrible times coming or for the tough times that might come in the future. That is what is main purpose of this counter cyclical capital buffer. And apart from that, if you see, one more thing is the restrict bank from indiscriminate lending. So what happens is, when a lot of money is there with the bank without even, sometimes what happens is they sometimes lend it to the wrong person, or a person who does not have the actual potential to repay. So this type of wrong borrowing, wrong lending might happen. So we saw the two main reasons for this for introducing the counter cyclical capital buffers. Now if you see in what form this will be stored. So in what form it will be maintained. So this will be maintained as common equity tier 1. Okay, that is, the counter cyclical capital buffer should be maintained in the form of common equity tier 1. And how much should the buffers be maintained by the Reserve Bank of India, and when will the Reserve Bank of India inform the bank to maintain? Will they tell today and ask them to maintain from tomorrow, or when will they inform? So this we'll see it in detail. If you see the counter cyclical capital buffer, it does not have a definite percentage like a repo rate or like cash reserve ratio, that is CRR. They will tell, right, it should be 4% or 4.5. Similarly, SLR also, it will be either 18% or 15%. So a definite number will be set by the Reserve Bank of India, right? But here, if you see the counter-cyclical capital buffer, it might vary between 0 to 2.5% of the risk-weighted asset. Okay, so it may vary between 0 to 2.5%. And why is that variation? See, the counter-cyclical capital buffer need not be maintained always by the banks. Whenever the RBI instructs the banks to maintain this buffer, only then they are required to maintain. But CRR and SLR, they have to maintain always, right? So this only when the Reserve Bank of India instructs the banks to maintain, only then if they have to maintain, otherwise they do not have to maintain. So the main indicator that makes the decision, that triggers the RBI's decision to whether create this buffer or not, is the credit to GDP ratio. That is the credit provided to the banking system and the GDP of the country. This value is the main thing that triggers this buffer, whether it has to be maintained or not. Apart from that, if you see, even the gross NPA is also an indicator, but this is a very main indicator. Okay, when this credit to GDP ratio enters 3%, okay, enters the value 3%, that time the Reserve Bank of India instructs the banks to start storing the buffer. Okay, so and when it reaches the 15% value, when this credit to GDP ratio reaches a 15% value, that time they have to maintain the maximum buffer, that is 2.5%. So as the credit to GDP ratio travels from 3 to 5%, so will the buffer also travel from 0 to 2.5%. Okay, so this is how the Reserve Bank of India sets the percentage, that is how much the buffer has to be maintained by the banks, and that is mainly dependent on this indicator, that is credit to GDP ratio. Apart from that, there are a few other indicators like gross NPA too, but the main indicator is credit to GDP. Okay, so now we saw that how the percentage is decided, right? Now, when will the RBI inform the banks? So they will inform the banks lead time of 4 quarters. So before 4 quarters, say suppose now it is second quarter, means the previous financial year first quarter, they will inform that you have to maintain the buffer. Okay, so well in advance that they will inform. It's not like they will inform today and from tomorrow the banks have to maintain. So lead time of 4 quarters will be provided to the banks in order to maintain the buffer. So this is the entire concept behind this counter-cyclical capital buffer. Next is the liquidity coverage ratio. Now, what is this liquidity coverage ratio? It is a measure of banks' short-term liquidity strength. It is a measure of the bank's short-term liquidity strength. So this, if you see, it ensures that the bank has enough high quality liquid assets. Okay, it has enough high quality liquid assets to survive a 30-day financial stress. So basically, this will ensure that the banks have high quality liquid assets that are enough to carry on for the next 30 days. Okay, so here if you see, this is the formula for LCR. LCR is equal to high quality liquid assets divided by total net cash outflows over the next 30 days into 100. So whatever net cash outflow is expected in the next 30 days is that amount available with the bank, that too in the form of high quality liquid assets. So what are these high quality liquid assets? These are basically assets that can be converted into cash immediately with no time. Okay, with no time you can convert that assets into cash. That is what is called high quality liquid assets. From the name itself you can understand the meaning, right? So now if you see total net cash outflow, not the cash outflow, total net cash outflow, say in the next 30 days, the expected cash outflow is 800 crores and the expected cash inflow is 200 crores. So net, if you see, it is 600 crores, right? This amount of money is expected to go out and this much amount of money is expected to come into the banking system. The net cash outflow is how much? It is 600 crores. So this much amount of money, it should be in the form of high quality liquid assets with the bank. That is what this means. Okay, to ensure that they do not meet with any short-term liquidity crisis. That is the main purpose behind this liquidity coverage ratio. And this was introduced after the global financial crisis. Global financial crisis, it happened in 2008. After this only, this liquidity coverage ratio was introduced. Recently, if you see, in 2025, Reserve Bank of India introduced two more things. One is assigning additional runoff rate of 2.5%. Additional runoff rate of 2.5% to internet and mobile banking enabled retail and small business customer deposits. Now, what is this additional runoff rate means? First of all, what is this runoff rate means? Runoff rate, basically it means a percentage of deposits. A percentage of deposits that the regulators assume that the customers will withdraw. Okay, will withdraw during a crisis. Okay, for example, I'll tell you, say a bank has 100 crores of deposits, and if the runoff rate is 10%, then the bank assumes that 10 crore will be withdrawn. If the runoff rate is increased by 2.5%, then the runoff rate becomes 12.5%, right? Then the withdraw, okay, how much amount is expected to be withdrawn? It becomes 12.5 crores. Now, why this 2.5% has been increased only for the customers who have internet banking and mobile banking? Why is it so? See, previously, if you see, before the introduction of the internet and mobile banking, people, how do they used to withdraw the money? They used to go to the banks. Okay, even before ATM existed, they used to go to the banks. Only during the working days, they can come and withdraw money, right? Then, after that, if you see, after the branches, next came the ATM. So, you can withdraw the money from the ATM. And now, even more easier way, internet banking and the mobile banking. So, now, people who are having access to internet mobile banking, they can withdraw the money 24/7. They can withdraw the money whenever they want. So, here if you see the runoff rate for these kind of accounts, it is huge. It is higher, right, than people who do not have internet and mobile banking facilities, because they only have to come to the branch and withdraw the money. But people with internet and mobile banking, they can even withdraw the money at 12. They can even transfer the money to any other account at even at 1 a.m., 2 a.m. or 3 a.m. That is why the runoff rate for these kind of accounts has been increased by 2.5%. Okay, that is the reason to increase the runoff rate for these kind of accounts. We saw the formula of LCR, that is HQLA divided by net cash outflow in the next 30 days into 100, right? So, this HQLA, this government security, if you see, it is a part of this high quality liquid assets. Okay. So, now they are telling, that is the RBI is telling that you have to adjust the market value of the government securities with haircuts. So, what is this haircut? The main purpose of this HQLA is to convert into cash whenever the situation arises. Okay, whenever the situation arises, when tension kind of situation, the liquidity stress arises, you should be able to convert the assets immediately into cash. Say suppose the bank is holding 100 crores of government securities. Can this 100 crores completely be added as a HQLA in the calculation of LCR? Okay, in calculation of LCR, can we just add 100 crores completely as the HQLA because the bank holds 100 crores of government securities? No, you cannot add the entire 100 crores in the calculation of LCR. You should include the haircuts. Only after including the haircut, only the remaining value should be added in the formula. Now, coming to the haircut. Haircut is nothing but a margin. Okay, so here if you see the government securities, they can be used under the LAF. LAF is what? That is where the repo operations are there, right? In LAF corridor, if you see, you have repo operations, you have MSF and standing deposit facility. So, what is repo operation? In repo operation, banks give the securities to the RBI and then RBI in turn gives the money to the banks, right? That's what happens in repo. What happens? Banks give the securities to the RBI and the RBI gives money to the bank. So, when any stress situation happens, when a liquidity crisis happens, so when they want to liquidate this government securities, the banks can give the securities to the RBI. So, say suppose they are giving this 100 crores of security to the RBI. Will the RBI give the entire money to the banks? That is, if the securities are worth for 100 crores, will the RBI transfer the entire 100 crores to banks? No, it will not transfer. It will cut a margin. So, it will transfer maybe 95 crores or 97 crores only to the bank. Okay, remaining 3 crores or 5 crores, if you see, that is called as the haircut. That is what is called as a haircut. Okay, because if you see, why does the RBI does this? If you see, it is because the government securities, they are like market securities. Their values can fluctuate over time. It can increase or it can decrease. So for safety reasons, RBI does this haircut before giving or lending the money to the banks. That is why now in the calculation of LCR, if you see, you should not include the entire value of the government securities. A haircut should be there, and only after that haircut deduction, the remaining value only should be calculated in the HQLA. That is, remaining value should only be included in the LCR formula. So here we saw 100 crores of government securities are there, means in that a haircut must be done. See, suppose a haircut of 5 crores is done. The remaining 95 crores must be included in the LCR formula. Okay, only this 95 crores must be used for the calculation of LCR. That is what this means. Okay, that is to include the haircuts while calculating the HQLA, especially in respect to the government security. Next is investment guidelines. So if you see, we have discussed about deposit components, the loan, that is advance components, right? There's a third component in the banking sector, and that is called as the investments. Okay, so deposits, money gets into the bank. Advances, the money goes out of the bank. Similarly, investment also, it goes out of the bank. So investment, if you see, it is one form of the prospect of earning. Okay, one form of earning prospects for the banks. So here, if you see, they invest in various securities such as government securities, other approved securities, and also the debentures, also called as bonds, and also in the commercial papers. So these are the various instruments where the banks are allowed to invest, because apart from providing loan to the people, the banks can also utilize some idle funds that are lying to them. Okay, there is always a certain limit on how much they can invest in the government securities, debentures, and commercial papers. That is set by the Reserve Bank of India and that limit keep changing. Okay, so that change limit is also being reported by the Reserve Bank of India to the public also. So this investment guidelines, if you see, it is provided by the Reserve Bank of India, and the investment guidelines has to be followed by all the banks that are in India. So mainly, if you see, there are 3 categories of investments. First is HTM. What is HTM? HTM is held till maturity. That is, these are the securities or the bonds in which the banks invest. Okay, suppose the maturity date, now if you see, it is 2025, right? Suppose the maturity date is 2028. Then it means that the banks should hold the securities till the maturity date, that is till 2028. They cannot sell the bonds or the securities before the maturity date. That is what held till maturity means. You have to hold the securities or the bonds till the maturing date. Next category is AFS. That is, AFS is available for sale. And then last category is HFT, that is held for trading. So the main purpose of this HFT is to make short profit. Okay, that is, you can trade, you can buy the security now and you can sell it like after 10 days or 20 days in order to make profit. Main thing is here is to make profit. So there is no any time period that they have to hold the fund. They can sell it, they can hold the bond or the securities, they can sell it whenever they think that they are making good profit. And this AFS, that is available for sale, it is in between this held till maturity and held for trading. Okay, that is, they need not be held till maturity. If required, they can be sold before. If liquidity situation arises, they can be sold before. So this AFS is between held till maturity and held for trade. So how much the bank can keep it, and how much of securities can be allocated under HTM, how much under AFS, how much under HFT, all this is decided by the Reserve Bank of India, and they issue the directions to the banks which has to be followed. Next is know your customer. So this KYC guidelines, I'm sure many people would have heard about. KYC guidelines is also issued by the Reserve Bank of India. So before onboarding any customer into the banking system, it is very important to collect the various ID proof, address proof details. It has to be original also, right? It should not be fake. So verifying, not just getting the ID proof or address proof, you should also verify whether it is genuine or not. That is the task of the banking employees. So all that proper directions, they are issued by the Reserve Bank of India. So critical for protecting the safety and soundness of the banks and integrity of the banking system in the country. So if you see, time to time, the RBI has issued Know Your Customer, anti-money laundering, combating financing of terrorism. So all these guidelines are issued by the Reserve Bank of India. If you see, Reserve Bank of India majorly classifies the customers into three categories. First is the high risk customer. Next is medium risk customer. The last one is the low risk customer. Okay, say suppose you are going to the bank. Okay, there is a person X, you are going to the bank to open an account. Okay, and you are providing all the details like Aadhaar card, PAN card for address proof and ID proof details. So the bank will collect those details and open a bank account, and you will start using your bank account for various purposes, for crediting, for debiting, for various purposes you will be using. So even after some time, okay, even after some 3 years or 4 years, if the bank requires, they can ask for your KYC details again. Especially this high risk, medium risk and low risk, if you see, there is a timeline. Okay, say suppose high risk it is 2 years, medium 8 and low risk 10. Okay, I'm not sure about the number of years. I'm just telling this for an example. High risk is associated with 2 years means every 2 years the bank has to get the latest KYC details from the customer and update it. What happens is that now once the customer comes and opens the account with the bank, and after 1 year his address might change or his phone number might change, anything other things might change, okay, and he fails to update it with the bank for that purpose also. So it is also better for the customer to come and update. Even if he fails to update it, the bank will ask him in a duration. So if you open an account today, after 1 month and 1 month itself, the bank is not going to ask come and give your KYC details again. There's a timeline. So they will classify the customer based on the transaction detail, based on the profession. They will classify them high risk, medium or low risk. And depending upon that, if it is a high risk customer, then once in 2 years, the banks will ask the KYC details from the customer and update it in their account. Similarly, medium risk customer means they will ask the KYC details once in 8 years. Similarly, low risk means once in 10 years. So this is how the KYC updation happens on a continuous basis. Okay, it's not that you open your account, you provide the KYC details and then the bank does not follow up. No, the bank also follows up. Okay, this is to ensure that you are a genuine customer and you are also using the account properly and not for any wrong reason. That is why this anti-money laundering also. People use the money for many wrong deeds like for terrorism financing and many other wrong deeds, right? So to combat that also, if you see, the bank keeps issuing updated circulars. So to ensure that if the fraudster is using any new means, that has to be combated. So regarding that, new circulars are always published by the Reserve Bank of India. If you see recently, even the mule account, you would have heard about this in the current affairs. So what is mule account? Mule account is when the fraudster will use a genuine account, okay, a genuine person's account. Using that account, you will convert the black money into white money. That is what is called as the mule account, okay. So RBI is trying various measures to combat this reduction or complete stoppage of this mule account usage. These are the various things that is done by the RBI. These are the various directions given by the RBI to the banks regarding this Know Your Customer. Next is corporate governance. So what is corporate governance? Corporate governance in banks, if you see, is the system by which the banks are directed and controlled to ensure financial stability, integrity, accountability and the protection of stakeholders, particularly depositors. So corporate governance is to ensure that the banks are running properly, they are following the rules properly, and also they are ensuring that all the stakeholders, it is not just the depositors, the shareholders, investors, everyone should be treated in a very fair manner. For that, if you see, there are a lot of things under this corporate governance. Like you have to onboard the directors. There are certain directions or there are certain conditions that has to be followed when onboarding the director. That is, he has to have good financial knowledge, good economical knowledge. He should not be involved in any case. He should be of sound mind. He should be of minimum of this age. All this, if you see, is set by the Reserve Bank of India, and this has to be followed when the banks try to recruit any directors into their board. And similarly, apart from that, even the CSR, the corporate social responsibility, also is defined under this corporate governance only. That is, you out of a percentage out of your profit should be used for improving the society, okay, because you are earning money from the society, right? So you have to give something in return to the society. So on like if you are making a profit, of course, if you are making loss, you don't have to allot such money. But if you are making profit, then certain money, certain percentage should be allotted. So all that is defined under this corporate governance, and this corporate governance for the banks, it is issued by the Reserve Bank of India. So main reason is to protect the interest of all the stakeholders, and the need for good corporate governance has been gaining increased emphasis over the years. So previously, if you see, not so many companies or not so many banks were listed in the market. So if you do not properly apply the corporate governance, if you don't properly follow the corporate governance, you can be punished not just by the regulators but also by the investors. So your shares will go down, it will be covered in the market, in the news. So that is why it is very important to follow the corporate governance guidance. Next is deposit insurance. So this, if you see, we would have heard about DICGC, right? Deposit Insurance Credit Guarantee Corporation. This is one of the subsidiary of Reserve Bank of India. So we had covered this DICGC under the subsidiaries part of the Reserve Bank of India. So what is deposit insurance? The deposit insurance protects the depositors against the loss of the deposit in case a deposit institution is not able to meet its obligation of the insured depositors. So this, if you see, NBFC is not covered. This is one main point. NBFC is not covered under this deposit insurance. The other banks, cooperative banks, all of the banks are covered under this deposit insurance. So the subsidiary of the Reserve Bank of India provides deposit insurance up to amount 5 lakhs. So this amount kept changing. Okay, the latest amount is 5 lakhs. And if you see, if there is an insurance, a premium has to be paid, right? So if you are taking any life insurance or term insurance, obviously you are paying a premium amount to the insurance company. Similarly, here also the premium has to be paid, but who pays the premium? It is not the customers, but the banks. Okay, so remember, if they ask you that who pays the premium for the deposit insurance, then you have to know that it is banks and not the customers. So banks pay the premium amount, and the maximum amount of insurance is 5 lakhs that has been provided by the subsidiary of the Reserve Bank of India. The next topic that we are going to cover is the Credit Information Company. So if you see, RBI is the organization that also regulates this credit information company. So apart from the banks, NBFC, the RRB, Small Finance Bank, all these, apart from these organizations, the RBI only regulates the credit information companies. So what is a credit information company? Basically, if a person goes to a bank, the bank will obviously get various ID details like Aadhaar, that is address proof details, and also the ID details like PAN. Okay, so all these details will be collected, and they will check his history. What history? His credit history. Whether he has got loan from previous banks, whether if he has got the loans, has he paid the loans perfectly or not, on time or not, or is there an overdue? So through this, he will be able to assess the discipline, okay, the financial discipline of the borrowers. This is a very important thing for the banks. Okay, so who does this for the banks? It is the credit information company. Okay, so all the credit information of the borrowers are collected by the credit information companies, and a consolidated information is provided to the banks, and that is what is called as the credit information report. So now if you see, even not only the banks, even you or me, if you want, you can go and see your credit report also in Policy Bazaar, and so many apps that provides you that feature where you can go and check your credit report. Okay, so here RBI is the person or is the organization that regulates the credit information company. Like it will tell that even recently, if you see, maybe this video is recorded in May 2025. So if you see recently, maybe 3 or 4 months back also, they have mentioned that within 15 days, or within 15 or 7 days, has to be uploaded. That is, suppose if bank sends any information to the credit information company, like the loan has been closed by the person, then within 15 or 10 days, it has to be updated in the report. Okay, so these kind of information, these kind of instruction is provided by the Reserve Bank of India. The previous timeline has been reduced. The main thing is that previously, if the credit information company used to take 30 days to update any customer's information, now it has been reduced to 15 days. Okay, so that it ensures that the latest credit information report is available to the banks and also the customer also. The customer, if he has closed the loan, then it has to be reported in the credit information report also immediately, right? So that if he wants any new loan, he can take it. He need not wait for another 30 days for that information report to be updated. So it is a win-win situation both for the banks and for the customer. So these kind of updated instructions, they are given by the RBI, and the credit information company has to follow it. Okay. So if you see, the credit reporting addresses a fundamental problem of credit markets, asymmetric information between the borrowers and lenders, which may lead to adverse selection, credit rationing, and moral hazard problems. Credit reporting system consists of the institution, individual, with procedures, standards and technology that enable information flow relevant to make decisions relating to the credit and loan agreement. So this plays a very vital role in deciding whether the bank has to provide loan to the borrower or not. Okay, and currently if you see, there are 4 credit information company in India. First, Sibyl, next CRIF, third is Experian, and fourth is Equifax. So there are currently 4 credit information companies, and these are the 4. Since it is very less in number, you have to remember the 4 credit information companies. Next is regulating NBFCs. So we saw that the NBFCs are also regulated by the Reserve Bank of India. NBFC, if you see, they are broadly classified into deposit taking and non-deposit taking NBFC. Okay, so there are NBFCs which can accept deposits from the people, and there are NBFCs which cannot accept deposits from the people. Okay, so deposit taking NBFCs are regulated or are supervised more tightly than the non-deposit. And also recently, if you see, the RBI had classified the NBFC into 4 tier: base layer, middle layer, upper layer and top layer. And they will also, time to time, they will also be updating which are the NBFCs that are classified as base layer, middle layer and upper layer and the top layer. Currently, if you see, the top layer is empty. Okay, so they are classified. Now, NBFCs are classified into 4 tiers, and that classification was made by the Reserve Bank of India. We have covered NBFC topic in separate. Okay, so you don't, you just have to know about this small information now. In NBFC topics is completely covered in a separate chapter. Because NBFC, if you see, there are various types of NBFC also. NBFC that deals only with stocks, NBFC that only invests in the infrastructure. Okay, so there are different NBFC which invest only in the housing societies. So there are various types of NBFC, and each NBFC, they have to maintain a different net worth. Okay, so that is why I am not covering in detail now, because it will be again a repetitive one. So that is all covered in the NBFC chapter in detail. Next, we are going to see the supervision. So till now what we saw is regulation. Okay, now we are going to cover the supervision part. So what is supervision and what is the difference between regulation and supervision? Okay, regulation, if you see, they lay down the rules. Okay, so rules are laid down, like the RBI instructs the banks to maintain CRR, SLR. Okay, all these are the rules that are laid by the RBI, like even the priority sector lending, all these are rules. Supervision is to ensure that they follow the rules. Okay, just laying the rules is not very important, right? That has to be properly implemented. That is also done by the Reserve Bank of India. So the role of RBI in supervising is that ensuring that the rules that are laid down are properly followed, are properly diligently followed by the banks. So if you see, till 1993, regulatory as well as the supervisory functions over the commercial banks were performed by the Department of Banking Operation and Development. But in November 1994, a Board of Financial Supervision, Board of Financial Supervision was formed to solely focus on the supervision activity. And this, if you see, it is headed by the chairman. And who's the chairman? It is the governor. He himself. Okay, he himself is the chairman of this Board for Financial Supervision, and this is under the Central Board of Directors also. And also, if you see, in August 1997, in order to ensure that even the NBFCs are given equal importance in supervising, there was a 2 different department for NBFC, non-banking supervision, okay, and then Department of Banking Supervision. So 2 separate departments were formed in the 1997 for supervising the non-banks and also the banks. So this is what is a definition of supervision, that is enforcement of rules and regulations that are formulated by the regulator to govern the behavior of the regulated institutions at the same time, spot loopholes or grey areas where regulatory reinforcements may be due. The rules are laid. Okay, the 2 things are here. If you see, there are 2 things here. First is ensuring that the rules and regulations are properly followed by the banks. Second, if there is any loophole that the banks have found and they are using the loophole, then that loophole has to be closed. Okay, so a new set of rules or regulations has to be framed. That is also how, that is also being found by the supervisor. Okay, so it is the supervision or the supervisors who finds out the loopholes and instructs the regulator that okay, there is a loophole here, maybe have to close the loophole. How do we close the loophole? By loophole, how? By creating even new rules and regulations. So this is the main function of the supervision. Okay, we saw the supervision, right? So how is the supervision done? We saw the rules and regulations. So what are the rules and regulations? The CRR, SLR, the PSL. So all are the rules and regulations. Now, how is the supervision done? So previously, if you see, it was the camels based approach that was used for supervising the banks. What is camel? The full form of camels is capital, adequacy, A for assert, quality, M for management, E for earnings, L for liquidity, and S for sensitivity. Okay, this is the full form of camels, and this was the approach that was used by the Reserve Bank of India in order to supervise the banks. But if you see, later on it has changed. Okay, so for two reasons it has been changed. First is there is a growing recognition that banking in traditional sense of accepting deposits and for the purpose of lending is no longer in vogue, and banks and banking are becoming complex, because previously when this approach was introduced, the prime purpose of the banking was to just provide deposits, provide loans. But now if you see, the banking is becoming even more complex, right? So that is why more supervision is required, and the method of supervision also has to be changed. That is one reason. Second reason is that the realization that supervisory resources are scarce and it need to be optimally deployed to meet the supervisory goals. The supervision, if you see, who is doing the supervision? The RBI. But the banks, NBFCs, the rural bank, the small finance bank, it is all growing exponentially. But there is only one RBI, that is only one regulator. So how can they do? So that is why their supervisory resources are scarce. So you have to make the utilization at the potential level, right? So that everything is supervised in detail. For that purpose also the supervision has been changed, and now if you see, it is the RBS supervision. This is called as the risk based supervision. So RBS supervision is being currently followed by the Reserve Bank of India. So from camels approach, we have shifted to the risk-based supervision mainly for these reasons. That is, banking has been becoming complex, and also one supervisor it's very difficult for one supervisor to supervise all the banks. So in order to make it efficiently supervised, this approach has been selected by the Reserve Bank of India. So we saw in the previous slide that from camels based supervision, the banks moved to risk based supervision. So now if you see, the RBI governs or supervises the banks based on the risk based supervision, and the risk based supervision framework in India, it is called as the SPARK. The full form is Supervisory Program for Assessment of Risk and Capital. This is the full form of SPARK, and this is the supervision that is being used. So using SPARK only, the RBI supervises the banks. So various features of SPARK, if you see, it is a tailored supervision. So here if you see, it is a risk based. It means what? Depending upon the risk, it is supervised. Previously, if you see, all the financial institutions, okay, whether it is high risk or low risk or medium risk, all the financial institutions were supervised in the same manner. But that should not happen, right? The institutions which has a lot of risk, which has very high risk, has to be supervised more diligently, more severely than the supervision done in the low risk, right? Say suppose there is a bank, okay, and the balance sheet size of the bank is say 1 lakh crore. This is just for an example I am telling. Okay, and there is another bank and that balance sheet is just 1000 crores. So can you use the same amount of supervision, same level of supervision, both 1000 crores balance sheet and 1 lakh crore balance sheet? No, right? It is very huge. 1 lakh crore balance sheet bank has to be supervised even more diligently, even more strongly. then the 1,000 crores. So previously, if you see, all the banks, all the financial institutions were supervised using one method, but here it is a tailored supervision. That is, depending upon the risk, depending upon the size, the complexity, the supervision is done. Next is focus on high risk areas. So under the bank itself, there are various types of risk, and each type of risk has different intensity, right? So certain risk like credit risk, it might be more riskier than the other type of risk. So you have to focus on the risk which has high priority, which requires more attention, and depending upon that, the supervision must be done. Next is forward looking. So that is forward looking, like what if depending upon the future risk, now itself you have to find out the problem. Okay, rather than the problem happening and then finding out the solution, it is better to be proactive, right? So you have to continuously govern the environment. That is what is called as forward looking. You have to continuously govern the current environment, all the stakeholders, all the depositors, all the borrowers, everything should be continuously governed, so that whatever future risk happens, you should be prepared to manage that risk. That is what is called as the forward looking. That is, you have to anticipate the future risk that might arise. For that, what you have to do? For that, all these you have to keep governing all the stakeholders and all the entity around you. So this is what is called as continuous monitoring. So continuous monitoring will help in the forward looking situation. These are the features of this smart supervision. Next, if you see, there are two types of supervision. One is off-site, the other is on-site. Off-site is it is a kind of remote supervision, where the bank is at a different place and the RBI who is supervising is at a different place. Here on-site means the name itself, you can guess that on-site, that is, the regulator will be on-site, that is where the bank is there. So generally, if you see off-site supervision, it has assessment of their business plan or strategy, then the financial statement, that is the balance sheet, profit statement, the cash flow statement, then the compliance, audit reports, and the observation of the external auditors. All this is governed, all this is assessed by the Reserve Bank of India. So here the RBI is at different place and the banks are at different place. So all the reports that the banks submit, all the business plan, all the balance sheets, all this is assessed by the RBI. And also RBI tells the banks that you have to submit your statements, that is the deposit statements, the NPA statements, the loan statements, everything should be submitted at a periodic time. Okay, whether it is fortnightly, monthly or quarterly, that is decided by the RBI, and during that interval, the banks have to submit those return statements to the RBI. Next, if you see, Central Repository of Information on Large Credits has been introduced in 2014. So what is this central repository? This, if you see, it is managed by the RBI. All the banks, okay, they have to report the loan accounts to the CRILIC, that is Central Repository of Information on Large Credits, if the total value of the loan is more than 5 crores. That is, if the exposure to the borrower is more than 5 crores, then they have to report it to this CRILIC, okay, because 5 crores is a very huge amount, right? So you always have to have a keen eye on this large borrowers, because when they do not repay, then it becomes a huge burden on the banks. So that is why this CRILIC was formed in 2014. So now we saw the off-site supervision. Now we will see the on-site. So here on-site, if you see, it does not happen on a regular basis. So previously in off-site, if you see, the report submission, the assessment, it happens on a regular basis. But this happens once in a year or once in 2 years only, depending upon the risk of the financial institution. So here, if you see this on-site, it complements the off-site. Okay, so off-site, on-site, both are equally very important, because here on-site, they will validate, okay, they will check whether the data or the report that has been submitted in the off-site operation is valid or not, is correct or not. What happens is sometimes the NPA reported by the banks are very less. Okay, say suppose there is a bank X and the actual NPA in the bank is 100 crores. But what happens, sometimes they report only 80 crores and they hide that 20 crores because NPA is not good for the bank, right? It is like rust to an iron. So having a lot of NPAs will worry both the depositors as well as the investors, the shareholders, the promoters, everyone. So that is why, to have a good picture, okay, to have a clean balance sheet, what they do is under-report the NPAs. They do not report the correct NPA. This has happened in various scenarios. You might have read it in the current affairs also. So they under-report the NPA. Okay. So this, how can it be validated? So they submit the report in the offsite. And whatever is submitted, we cross-verify and we check it and we proceed. But when you actually go to the site and if you check whether it is actually 80 crores or 100 crores, when you go to that site, you can check. So that is why it is very important. On-site is also equally important as off-site. That is, it helps in validating the off-site reports that have been submitted. Whether the off-site reports that have been submitted is right or not, or it is cooked up, that can be found out in this on-site supervision. So conducting validation checks of the data gathered under the off-site surveillance. That is mainly done in this on-site supervision. Next is following up on issues identified from the previous assessment. Say suppose an audit had taken place in 2017 and now the second audit is taking place in 2019. Okay. So in this 2017 audit, whatever has not been completed or whatever deficiencies is there, that the auditor, that is the RBI auditor, would have stated, right, these are the deficiency. You have to complete it. That if is checked in 2019 audit. So the 2019 audit, what they do is mainly as soon as they come, they will check that, okay, some deficiency would have reported in the previous audit, right? Have you completed it or not? If you have completed, show me the proof. So that is also done. That is the following up on issues identified from the previous assessment. That is also done in this on-site supervision. Okay, so these are the various ways this RBI supervises the banks. Apart from that, there's one more thing also. So this, if you see, it is para supervision activities. So here it is, if you see, this is a supplementary to both off-site and on-site supervision. So an extra, always an extra level supervision is good both for the banking system and for the economy, right? So that is also done by the RBI. So let us see them one by one. First is the Central Fraud Registry. So this Central Fraud Registry has been operationalized with effect from January 2016. See, in the previous one we saw Clerk, right? And I also mentioned that since when it was operationally, and also I have mentioned that what loan amount, okay, if the borrower, if the bank has exposure to a borrower above than this amount, then it has to be reported to Clerk. You have to know the numbers, okay. These are very basic numbers, the 5 crores, and when this Clerk was established, and when this CFR, that is Central Fraud Registry, was established. These are all objective point of questions, so you have to know these basic numbers. Rest all is a concept based only, but these are objective points. So do remember the number and the year it was established. Okay. So this has been established in Jan 2016. The CFR will provide a searchable centralized database for use by banks, which in turn can alert the banks to take necessary steps to develop a sound and the robust fraud risk management system. So Central Fraud Registry, from the name itself you can guess that all the fraud accounts will be listed here. Okay. Who lists it? It's the RBI who lists it, but if you see, it has been reported by the regulated entity. The regulated entity would have undergone certain fraud accounts, right? So certain fraud borrowers would have been there in their organization, in their regulated entity balance sheet. So all those fraudulent credit account or loan account, it will be reported in this CFR. So in future, if any bank wants to give a loan to anybody, they have to come and first check whether that person is there in this registry or not. And then he can do other checks and then provide loan to the borrower. This is to ensure that he does not give money to the fraudsters. Okay, so that is the purpose of the Central Fraud Registry. See, fraud is different from not paying the loan. Okay, a NPA borrow is different from a fraudster. NPA borrow, sometimes he might not have money. Okay, the business for which he had borrowed money might have gone into loss. Then he couldn't pay the money. That is different because he doesn't have money or because his situation was totally bad. Maybe he was fired from his work. That is different. But fraudster, it's totally different. Okay, you portray to be this person. You give a fake balance sheet. You give a fake salary account. You don't actually have a job, but you give a fake ID, fake salary slip. All that is called as the fraud activities, right? So only those fraud accounts are listed here and not the NPA accounts. Don't get confused. Not the NPA accounts. Only the fraudsters who had done fraudulent ways to take loan from the banks. All those names will be listed in this CFR. So bank, before providing loan, they have to check this registry. Next is early warning system and action. So from the name, early warning system. So first itself, before a problem bursts, okay, if before a small problem becomes a big problem, a problem that cannot be solvable, it is good to be proactive and finish the problem when it is in the smaller stage itself. So how can that be done? It can be done using the early warning systems. So the regulated entity, they develop early warning systems before the problem becomes a big problem. Say suppose I'm telling for an example. Okay, there is a bank account, loan account. When does the loan account become an NPA? When there is no payment. This is for a term loan. I'm telling it for a term loan. when there is no principal or interest payment for 3 months, that is for 90 days straight, then that loan account becomes an NPA, right? So before the, why do you have to wait for 3? Like after 1 month itself, if there is no EMI credited to the loan account, then an early warning signal will be generated by the system to the bank employees. Say suppose to the branch manager. Okay, that time itself the branch manager can due diligently follow. Okay, can follow up the loan person and speak to him and find out the problem. If he has money, then insist him to pay the money. So all this can be done. So this, if you see, the loan account can be prevented from becoming an NPA account, right? If he doesn't have money, you can tell him ways, right? Maybe you can pledge your gold, using that money you can pay this amount. So you can tell some ways. Okay, you can find out the ways. So that is why early warning signal, it might help you in the small problem becoming a big problem. From here, after 1 month itself, if the bank employee finds out that okay, he hasn't paid the EMI for 1 month itself, he can follow up and he can prevent that loan account from becoming an NPA. This is what is called as the early warning system and action. Next is the stress testing. Okay, so in December 2013, RBI issued guidelines on stress testing and made it mandatory for all banks to carry out stress tests involving shocks prescribed in the guidelines at a minimum. Okay, so stress test means what? It is banks all will work fine when the environment is fine. When everyone is paying back the loan, then obviously the bank will work fine. But what happens at the type of stress? At the time of stress, what if there is a, like in the COVID kind of situation, it was a stress testing, right? It was a live stress testing because many businesses could not function. So it was very difficult for people to repay the loan. So that time is the bank functioning. When many people are not able to repay the loan, do the bank have enough capital? Can the bank, repay the deposits? That if the bank's depositors come and ask for the money, will the bank be able to repay even if the borrowers are not able to repay their loans? That is the pure stress test. So if you see, there will be high stress, medium stress and low stress. Okay, so various types of stress scenario will be provided by the RBI, and banks, they have to check whether they still have enough capital in all these types of stress, that is high, medium and low, and can they actually function even in these stress. Okay, because banks functioning is even more important in these scenarios than the normal scenarios. Because in normal scenarios, when everything is okay, functioning is not very big thing, right? When during the stress scenario, the banks have to function. The bank's need is even more during the stress scenario. So even in that stress scenario, will you be able to function? That is checked in the stress test, and that is checked by the RBI, and that was introduced in December 2013. Next is PCA framework. What is this PCA framework? PCA framework is prompt, corrective, actions. So basically, if you see, this is an early intervention tool by the Reserve Bank of India, mainly to restore the commercial banks that show weak signs of financial, that show financial weakness, recover them, recover those banks that are showing early signs of financial weakness. That is the purpose of this PCA framework. So how will the RBI know whether that bank is weak or not, or it is getting weak or not? So it will know that by monitoring 3 parameters. Okay, so those 3 parameters are capital, asset quality and leverage. So this, if you see, this is the parameter for commercial banks. The parameter for cooperative banks are different. That we will discuss in the next slide. For now, you have to remember that for the commercial banks, this includes even the foreign banks. Okay, commercial banks includes small finance bank and also the foreign banks also, that is having branches in India. They all are monitored using these 3 parameters under the PCA framework. So capital, if you see here, 2 things are monitored. One is the capital adequacy ratio. I'm sure you know what capital adequacy is. And second is the common equity tier 1. So here 2 things are seen. That is, one is the capital adequacy ratio. Second is the common equity tier 1. Next, asset quality. So here asset quality, if you see, net NPA. Net NPA is monitored. So you know what NPA is, right? NPA is when the customers fail to repay the loan and the loan turns into a bad loan. Okay, when you do not repay the loan for 90 days straight, no principal is paid, no interest is paid, then that loan becomes an NPA. So here if you see, there are 2 things. One is the gross NPA and the other is the net NPA. When you allocate provisions, so gross NPA minus provision made, you will arrive at the net NPA. This is the formula. Okay, I have mentioned it many times even in the current affairs. When you when you subtract the provision from the gross NPA, you arrive at the net NPA. And the last parameter, leverage. So what is this leverage? The leverage means how much of banks assets. So assets mean what? Assets are nothing but loans and advances, right? For banks, if you see, the assets are loans and advances, are financed by the bank's own capital rather than the borrowed funds. Okay, so here if you see how much of the own capital is used to give the loans instead of using funds. So you know that bank can provide loans using its own capital as well as the funds, that is as well as the deposits, that is the fixed deposit, savings deposit, the RD. All that money will also be used to provide loans to the customers, and also bank's own capital will also be used provide the loans to the customers. So here the leverage, it measures how much of bank's own capital is being used to provide the loans to the customers. Okay. Banks, if you see, they have to maintain a leverage ratio of 3.5%, and domestic systematically important banks. Domestic systematically important banks, if you see, there are currently 3 banks in India: SBI, HDFC and ICICI. So these banks, they have to maintain a leverage ratio of 4%. Okay. So this is the ratio that they have to maintain. That is 3.5% for the other banks, and DSIB banks, if you see, they have to maintain 4%. Now, so the first parameter, we'll check the first parameter. Capital, I told you, right? 2 things are seen. One is the capital adequacy ratio. Here, the CCB is also included. CCB is what? Capital conservation buffer. Banks have to maintain a capital conservation buffer of 2.5% and capital adequacy ratio of 9%. So when you add how much it comes to 11.5%, right? So here if you see, capital adequacy ratio 9% and capital conservation buffer is 2.5%. And among the capital adequacy ratio 9%, you know the capital adequacy ratio consists of 2 components. One is tier 1 and next is tier 2. Under tier 1 also there are 2 more components. One is common equity tier 1 and additional tier 1. So here if you see, 9% is for capital adequacy ratio, right? Common equity tier 1, how much should they maintain? They have to maintain 5.5%. Okay, they have to maintain. Common equity tier 1 should be at least 5.5%. So here 5.5% plus the CCB 2.5%, which comes to 8%. Okay, this has to be maintained. If this is breached, then certain actions will be taken by the Reserve Bank of India. Okay, the breach level is also divided into 3 levels. The first breach level is risk threshold 1. So risk threshold 1 is up to when the capital adequacy ratio plus CCB goes up to 250 basis points below the indicator, below this, which means that if the capital adequacy ratio and the CCB maintained by the banks is more than 9%, okay, it is more than 9%, but less than 11.5%. So it is in this range, more than 9% but less than 11.5%, then it is said to be that now the bank falls under the risk threshold 1. And here more than 6.375 basis point but lesser than 8. This is the actual maintenance, but it is lesser than 8 but more than 6.375. Then it falls under risk threshold 1. Similarly, risk threshold 2, 250 basis point but not exceeding 400 basis point. Here more than 162.5 basis point but not exceeding 312. And in this last risk threshold, if you see, it is 400 basis point below the actual amount. So which means 11.5 minus 4. So here maintenance is lesser than 7.5. So in this case, if you see, risk threshold 3. Okay, so this is how the risk thresholds are divided. Okay, depending upon the breach level, the risk threshold level is divided. This is for capital, parameter 1. Now moving to the second parameter. Second parameter is asset quality. So in this, if you see asset quality, what value is measured? Net NPA. So when the net NPA is more than 6% but less than 9%, it falls under risk threshold 1. And when it is more than 9% but less than 12%, it falls under risk threshold 2. And when it's more than 12%, it falls under risk threshold 3. Okay, this is very easy to remember. Next is leverage. So leverage for risk threshold 1, if you see, we know that the leverage that the banks have to maintain is 3.5%. When the banks are maintaining leverage more than 3% but lesser than 3.5%, then it comes in the risk threshold 1. Risk threshold 2 is when the leverage exceeds more than 50 basis points, and risk threshold 3 is when the leverage exceeds more than 100 basis points. Okay. So remember, it is very easy. Threshold 1 leverage, if you see, it is between 3 to 3.5%. Risk threshold 2, if you see, the exceeding is more than 50 basis point, and risk threshold 3, if you see, the leverage exceeds more than 100 basis point. So this is what this. Okay. So CAL, capital, asset quality, leverage. Now we will see what happens when the banks are placed in risk threshold 1, 2 and 3. Okay. So what actions the Reserve Bank of India will take when the banks are placed in each of the threshold. Now first we will discuss the risk threshold 1. When the banks fall under the risk threshold 1, what happens? So they will have certain restrictions on the dividend, distribution and remittance of profit. Note that the banks or any company, name any company, they will pay from their profits as they will pay dividends to their shareholders from the profits. So here if the banks fall under the risk threshold 1, then there will be a restriction on the dividend, distribution and remittance of the profits. And also promoters or owners, they have to bring in more capital. Okay. Next, if it falls under risk threshold 2, the actions that are mentioned in the risk threshold 1, that will also be applicable. Apart from that, one more action will also be applicable, that is restriction on the branch expansion, whether it's domestic expansion or overseas expansion. On both, restrictions will be laid. Next, risk threshold 3. So whatever restrictions are specified in the risk threshold 1, 2, that is also applicable. And addition to that, if you see, appropriate restrictions on the capital expenditure other than for technological upgradations within the board approved limits. So there will be a restriction on the capital expenditure. Capital expenditure means what? If you see, buying computer is a capital expenditure, right? So few restrictions will be there on the capital expenditure, except for technological upgradation. Technological upgradation alone, there will not be any restriction. Other than that, a capital expenditure restriction will be there. Okay. So you should know what are the restrictions under each risk threshold. Okay. This is the PCA matrix for the cooperative banks, primary urban cooperative banks. For the urban cooperative banks, this is the PCA matrix. Okay. So in the previous case, we saw it was CAL, right? For the commercial banks, the parameters were capital, asset quality and leverage. Whereas in PCA for urban cooperative banks, if you see, it is capital, asset quality and profitability. So instead of leverage, here it is profitability, CAP, cap. And one more thing is that capital in this in the commercial banks, if you see, capital means even capital adequacy ratio, CCB was also there. But here the capital means just capital adequacy ratio. CCB is not included. Okay. So capital adequacy ratio. This is the risk threshold 1, 2 and 3. Remember this, just read this once or twice, you'll remember. Okay. You should know the numbers. You should know the numbers both for commercial banks as well as for the cooperative banks. You should know the numbers under risk threshold 1, 2 and 3. Next, asset quality, it is the same as the previous case. More than 6% but lesser than 9%, more than 9% but lesser than 12% and more than 12%. Last one, profitability. So here it is net profit. So when it incurred losses during 2 consecutive years. So when during 2 consecutive years, then it is said to be under the PCA. Okay. So these are the 3 parameters you should know. The next main function of RBI is currency management. So we know that how important currency is in India. So though the digital development is very high, though the UPI usage is increasing every month. If you see recently, even March 2025, the overall UPI transaction was worth around 14 lakh crore. So this huge the UPI development is, but in spite of that, if you see every year, the amount of currency that RBI prints, it keeps on increasing. So digital also keeps on increasing. Simultaneously, if you see the RBI currency notes, it also keeps on increasing. So the RBI currency notes, if you see, it is printed across 4 press notes. Okay. So 4 press are there. 2 press are managed by the Reserve Bank of India and the 2 press, they are owned by Government of India. Okay. 2 press are owned by Reserve Bank of India and 2 press are owned by Government of India. So these are the only press which prints currency notes in India, and RBI is the only one who is responsible for distribution of currency in India. So we have discussed about the 4 currency press and where they are located and which 2 are owned by the Reserve Bank of India and the Government of India in already one of the chapters of the Reserve Bank of India, where we had covered the subsidiary. Okay, we know we had covered the subsidiaries of the Reserve Bank of India in detail. In that we had mentioned the currency press in detail. Okay, so if you haven't checked that video, do check it. Okay, so in that we have covered the currency press in currency presses in the country. And also if you see how the currency distribution happens in India, if you see, it does not, RBI does not give the currency directly to the people, right? This is not the way it operates. How does it happen? So RBI will give the currency to the bank, and from the bank people will get the currency, like State Bank, ICICI Bank, HDFC Bank, Bank of India, Indian Bank, so many banks are there, right? So again, the RBI does not give the money directly to the branches of the bank. Okay, this does not happen. So how does it happen? There is a middleman, that is called as a chest branch. So there is a chest branch. Reserve Bank of India will give the money to the chest branch, and then the chest branch will provide money to various branches. So if you see in the chest branch, what happens is that the entire money is stored. Similarly, if the branches, if they have excess money, they will give the excess money to the chest branch, and again the chest branch will give the excess money to the Reserve Bank of India. So this is how the circulation of money happens. Okay. So Reserve Bank of India does not give money directly to the people. It reaches the people via chest branch and the bank branches. Okay. So if you see the chest branches, they are owned by the Reserve Bank of India. So Reserve Bank of India will go and conduct the inspection on a regular basis on the chest branch. Okay. To ensure that they are properly, the money is properly stored and all that, it is all sorted. So to check that the soil notes are taken, it is given back to the Reserve Bank of India. So all this is checked by the Reserve Bank of India, because the chest branches, they are owned basically by the Reserve Bank of India. This is how the money is distributed by the RBI. Main functions of RBI under the currency management, if you see, issuance, distribution, maintenance, that is to ensure that you have to maintain, right? That is, it keeps on checking how much currency is in circulation, how much currency has to be printed, how much has to be distributed. All this is taken by the Reserve Bank of India, and one most main point is security of the notes. So all this is ensured by the Reserve Bank of India. So if you see, it ensures the smooth functioning and also ensures that the public has confidence. Okay, this is one of the main things. These are the main things that the RBI do. That is, ensure the smooth functioning takes place. Public has confidence in the banknotes, and in order to gain public confidence in the banknotes, what RBI has to do? To combat the counterfeit notes. That is, the fake notes that are being distributed, always RBI fights against it, tries to reduce the fake notes, increase the security of the features. This, if you see, it happens always. It does not stop. Okay, every time it checks if there is any fake notes are in distribution, and if they are, it tries to combat it by improving the security of the notes. So if you see currency notes in India, they are printed in a process called intaglio printing process. What is this intaglio? This printing process, unlike the other printing process, it will have a raised feel. So if you see, if you touch our currency notes, you will be able to feel the numbers, right? So in other printing, normal printing papers and all, you will not be able to feel. So this will give you a raised feel. The main purpose of this, again, to increase the security. Okay, that is the main piece. So it is very, it cannot be easily incorporated by the people who are printing the fake notes. It's a little difficult for them. So in order to make difficult for them, this intaglio printing process, so it will be a raised feel. So when you spread your fingers around or across a currency note, you will be able to feel the letters and the numbers. This is what is called as the intaglio printing process. And also RBI ensures that the printing presses, whatever instructions is given by the RBI to the printing presses, all that are followed or not. That is ensured by the RBI. So RBI goes on checking. Okay, it also continuously checks the presses and ensures that they follow the rules that are railed by the Reserve Bank of India. Suppose RBI tells one rule, but if the security press is not following, then what is the use, right? So it also ensures that the presses are following the security features informed by the Reserve Bank of India. So what are the other security features? Apart from this intaglio printing, what is the other security features that is incorporated by the Reserve Bank of India to reduce the fake notes? So that is watermarks is also there. Security threats are also there, imbibed in our imbibed in our currency notes. Then micro lettering. Then very intricate designs, which is very difficult to copy it in the fake notes. And the optical variableness. So these are the various things apart from this intaglio printing that the RBIs incorporate to improve the security features. Okay, so these are the security features followed by the Reserve Bank of India while printing the currency notes. This and all, if you see, it is very rare to be asked in the exam. Okay, phase 1 or phase 2, it is very rare to be asked, but you can use this if they ask you in the interview. Okay, in the banking exams interview, if they ask you, you can tell them, right? If they ask you what other measures taken by the Reserve Bank of India to combat the counterfeiting, so you can mention all this. So for that you can use intaglio print. If you tell that RBI follows the intaglio printing process and all, obviously the interview will be very impressed by you, because this is a very unique word. Okay, so when you tell this, or the interviewer will be very impressed. So this will help you fetch more marks. Okay, so it's not wrong in knowing few details. This, again, I'm telling you, this may not be asked in phase 1, phase 2, but it can be very useful in your interview if they ask this question. Okay, so remember writing this down. Okay, remember writing these unique words, because this intaglio, it is a difficult word, so it might not register in your mind immediately. So just try to write them in a notes where you will see on a day-to-day basis. Next, if you see RBI, so these many security features are there. Okay, but how will the public know? So that is also the sole responsibility of the RBI. So RBI conducts awareness campaign to inform about the various security features of the notes. It also guards against the counterfeit currency. So previously, if you see, before the TV era and the radio era, what RBI used to do is that they would go to the various places, to especially the rural areas, and they would conduct camps. So they will conduct camps and inform. Now, if you see, they are already available on the televisions also. If you see Mrs. Money, all this, right, you would have seen the animated feature, right? So all this is now available. So here, even via the television, YouTube, even via WhatsApp, all this awareness is created by the Reserve Bank of India. So now we're going to see about the demonetization. So what is demonetization? Demonetization is nothing but specific currency notes or coins are declared invalid or no longer legal tender. That is what is called as demonetization. Now, why is demonetization done? Main purpose, there are multiple reasons. So if you see, curbing the blank money. So that is one of the reasons. That is, what is black money? Unaccounted wealth. Okay, these are the wealth that is hidden from the income tax departments. So to bring the unaccounted wealth, to bring the black money into the picture, this demonetization is conducted. So unaccounted wealth, often referred to as black money, which may be accumulated through illegal activities or tax evasion. So how do we bring this money back? So this is one of the way. This is not the only way. Demonetization is one of the way, trying to bring back the unaccounted wealth. Next is combating counterfeit currency. So what if a lot of fake notes are in supply? So you can't go and check each and every note what people have, right? So instead of that, stop printing the existing note. Instead of that, print another note with higher security features. So you tell them, right, when suppose say example 100 rupee note. The fake notes of 100 rupee note are supplying in a very huge number. Okay, so how can you tackle it? It is very difficult to tackle such a huge number, right? So in that case, what the RBI does is that they will tell that this 100 rupee note is no more valid. So when they tell that all the fake currencies, they cannot be used. Okay, they are useless now. So instead, what RBI will do, that they will print another 100 rupee note with a better security features. So through this, what happens? The counterfeit notes are combated or are completely put into non-use. So reduce the circulation of the counterfeit money and protect the integrity of the national currency. This is one of the reasons. Next, disrupting the illegal activities. So again, the same purpose, the sudden withdrawal of certain currency notes can disrupt funding of illegal activities such as terrorism, drug trafficking and corruption. So for these various reasons, demonetization is done. So if you look at the history of demonetization, so when all demonetization was done in India. First, demonetization was done in 1946. So Reserve Bank of India seized the circulation of rupees 1000 and rupees 10,000. So they declared that 1000 and 10,000 notes will no longer be valid. Next, in 1978, the demonetization of 3 notes took place, that is 1000 rupee note, 5000 and 10,000. Next, again in 2016. So I'm sure everyone would be aware of this 2016 demonetization. So in that, 500 and 1000 rupee notes were taken out of the system, and if you see, the 500 and 1000 accounted for the major cash flow, that is, they accounted for 86% of the country's cash flow circulation. That much contribution the 500 and 1000 rupee notes had given, and this 500 and 1000 rupee notes, if you see, the 500 was replaced by a higher security feature enabled 500, and 1000 rupees stopped printing, and instead of that, 2000 rupees got replaced. Okay, 500 got replaced by a better security 500 rupee note, and 1000 stopped printing and 2000 rupees got introduced. And now if you see, RBI has also withdrawn this 2000 rupees from circulation. So I'm sure you would be aware of this. So as of May 2025, if you see, this 2000 rupee note is not in circulation. RBI has also stopped printing, and also RBI has informed all the citizens to deposit all their 2000 rupees note in the banks, and now since the deadline has crossed, now they can go and deposit with the Reserve Bank of India. So now the 2000 rupee is also not in circulation. So the highest monetary value is that highest currency value that is in circulation now currently, if you see, it is 500 rupee note. 500 rupee note is the highest currency value that is currently in circulation in our country. Next, we are going to discuss one more important function of RBI, that is payment and settlement system. If you see this payment and settlement system, it refers to the infrastructure and the process. So this infrastructure and process, it provides the transfer of funds between person to person, person to business, business to business, and then across financial institutions. We know, right, one bank transfer fund to another bank for various purposes. So for that also this payment and settlement system is required. So this infrastructure is provided by this payment and settlement system, and also if you see, this provides the framework for various payments method like cash, checks, electronic transfer, digital payments. So for all this, an infrastructure is required, right? So everything is provided by this payment and settlement systems. So if you see, there is a board that controls this payment and settlement system. So that is the Board for Regulation and Supervision of Payment and Settlement System, that is under RBI. Okay. So this basically, it is a subcommittee of the Central Board of RBI. So this Board for Regulation and Supervision of Payment and Settlement System, this is a subcommittee under the Central Board of the RBI. So what is the main function of this? So if you see authorization, we have seen in a lot of current affairs news, right? If any entity wants to issue prepayment instrument cards, or if it wants to be a payment aggregator, they have to submit a request. So that is submitted to the Reserve Bank of India. So it is this board that provides the authorization. Okay. So apart from authorization, even the prescribing policies, see, that is, first of all, you have to be eligible to apply for it, right? That eligibility is also given by this board: authorization, prescribed policies, and also the setting standards. So all these three things, it is provided by the board. The Department of Payment and Settlement System, this will execute the directions. Okay, so board is the one which gives the authorization, the setting the standards, and the implementing work, it is done by this Department of Payment and Settlement System. Now let us look into the evolution of the payment systems. So first, initially we know we used to use only the currency notes or the coins, right? So in 1990s, there was only coins and notes. Then later on, if you see, the electronic fund transfer was introduced, that is the ECS. What is ECS? Electronic Clearing Service. This is the full form of ECS. Okay, so what is the purpose of ECS? In order to make bulk debit payments or credit payments on a regular basis. So if you see, if you had taken any loan, you would have given this ECS mandate to the bank. So what is the purpose? The purpose of this is that the bank is authorized to deduct from that source, the savings account which you have given every month, the EMI payment. So when you have taken a loan, you have to give the EMI payments, right? So thus that one, if you see, it is given through this ECS mandate. So you give the ECS mandate, you sign the ECS mandate, and you give it to the bank, and that now it has the authorization. So now monthly deduction will take place from your savings account to your loan account. So this ECS, even credit is there and also debit is there. That is ECS debit we saw, right? Similarly, ECS credit is when a company, if it wants to make every month salary payments, and that is done through this ECS credit. Next is NEFT. So I'm sure everyone is aware about NEFT. This National Electronic Fund Transfer. This is the full form of NEFT. Okay, so this is a half yearly settlement transfer. So this, what happens is that this money, if you send, it does not get credited to your account immediately. It takes around at least half an hour time for it to be credited into your account. So that the settlement, if you see, it takes place once in half an hour. That is what is called as the National Electronic Fund Transfer. And this, if you see, it was introduced in 2005. Remember the year it was introduced, because they might ask you in maybe match the following questions. Okay, which of the following is not rightly matched? So remember the year. So NEFT was introduced in 2005. Next is RTGS. So RTGS is real-time gross system. Okay, this instantaneously it gets credited into your account. That is the main difference between NEFT and RTGS. And one more difference is that in NEFT there is no any minimum amount, or there is no any maximum amount. That is, you can, if you want, you can send even 10 rupees under NEFT, and if you want, you can send even 7 lakhs or 8 lakhs under NEFT. But in RTGS there is a minimum amount, that is rupees 2 lakhs. So if you want to send any amount equal to or above 2 lakhs only, you can use RTGS. If you want to send 50,000, 60,000, it will not allow you to send via the RTGS mode. And maximum, there is no limit. Minimum, there is a limit 2 lakhs, maximum, there is no limit. And in case of NEFT, if you see the minimum, maximum, there is no limit amount at all. You can send how much ever you want under the NEFT. Next is CCIL. This is nothing but Clearing Corporation of India Limited. Okay. So this, if you see, it was set up in the year 2001. And this was set up by various banks, financial institutions and primary dealers. Okay. Now, what is the purpose of this CCIL? So here, if you see, this is responsible for the clearing and settlement of government securities, treasury bills, the forex market. So for all this, this is responsible. So what does it actually do? Say suppose there is two party, okay, entity A, okay, and there is another entity. Entity can be a bank or a financial institution. I'm just telling this for an example. Here, this entity, it has a government security, and this entity B wants to buy that government security, and this entity wants to sell the government security. Okay, so they get into a deal, and this entity has sold the government security to entity B, and this entity, but it has failed to make payment. That is, it has defaulted the payment. It has got this securities, but it has failed to make a payment. So to avoid this risk, CCIL comes into picture. So what does CCIL do? The CCIL, you see, there is an entity A, and here there is CCIL, and here there is entity B. So this CCIL comes in between these two. So here what happens is that this gives the guarantee. Okay. So basically the CCIL gets upfront some margin amount from the entities. So in case if they default in the future, the amount will be recovered from the margin amount, and that amount will be given to the selling government securities. Say suppose here entity B wants to buy the security, right? So this will give a margin amount upfront to the CCIL. Okay. And this entity A has sold the securities. What if after getting the securities, entity B fails to make the payment? So now that amount will be recovered from this margin and will be given to this entity A. Okay. So from just having one arrangement, that is one buy and selling arrangement between entity A and entity B, now it becomes two arrangement. Okay, that is an arrangement between entity A and CCIL, and an arrangement between CCIL and entity B. From one arrangement, it has now become a two arrangement, and this CCIL gives that guarantee, okay, and completes the transaction. So this, if you see, this two new, from one contract, it has become two new contracts, right? This term is called as novation. Remember term, it is very unique, okay? This term, it is called as novation. So here, the contract between the buyer and the seller, it gets replaced by two new contracts between the CCIL. And here, this process is known as novation. Remember the name, it is very unique. If they ask you in the future that this, they explain you the entire purpose, okay, entire meaning of novation, and if they ask you what is the term of it, and if they give you 5 options, you should be able to answer it, okay. Next is the IMPS. So here if you see, the full form is Immediate Payment Service. So this was introduced in 2010 by the National Payment Corporation of India, where the immediate money transfer takes place. And here this IMPS, it is available all in weekdays and weekends 24/7. This is available. Okay, initially NEFT and RTGS were not available 24/7, but now they are also available 24/7. Next is prepaid instruments. So what is prepaid instruments? Here is that you have to load money before usage, and then only you can make payment. So unlike debit cards, that will be automatically linked to your savings bank account. So as long as you have balance in your savings bank account, you can use the debit card, right? But here prepaid instruments, you have to load the money, and up to whatever money is left in that wallet, or it can be a card, or it can be a voucher. So till that purpose, you can use this prepaid instruments. Okay. And one more thing is that this prepaid instruments cannot be used in the cross-border transactions. Okay. So when you go abroad and all, you cannot use it. But this, if you see, say suppose any foreigner, where will this actually be very useful? If you see, say suppose they're a foreigner. Okay. That person has visited India. So he can avail a prepaid instrument from our bank, Indian banks. Okay. From any Indian bank, they can avail this prepaid instruments. Okay. Indian banks or even various foreign institutions financial institutions are also providing this prepaid instruments. So he can avail this prepaid instruments, and he can use this instrument in anywhere. If he buys anything from any merchant, there he can use. And even in metro payments also, you can use this prepaid instruments. So there it can be used. It can be very, very useful. One more thing, important thing that you have to remember, this prepaid instruments cannot be used in cross-border transactions. Next is National Payment Corporation of India. So this National Payment Corporation of India, we saw that it was the one that introduced IMPS, right? So this was introduced in 2009. Okay. And this was also the one that introduced the UPI. UPI, I'm sure everyone will be using. So NPCI was the one that introduced UPI to our India. So NPCI was established in 2009. And if you see, it is an umbrella organization. The main purpose of that is to operate various retail payment systems. There are various retail payment systems, like even the UPI, it operates, the IMPS that we just saw, the Bharat Bill payment system. So everything, it is operated by this National Payment Corporation of India. So if you see, this National Payment Corporation of India took over the National Financial Switch from IDRBT. This is, so IDRBT full form is Institute for Development and Research in Banking Technology. I am repeating once again, Institute for Development and Research in Banking Technology. So that used to take care of NFS, that is National Financial Switch. That now the NPCI takes care of this National Financial Switch. Now, what is this NFS? This is the biggest network of ATM. Say suppose you have an Indian bank ATM. Okay. You go to an SBI bank and you try to withdraw the money. Now, SBI bank will not have Indian bank account details, right? How it is able to disperse the money? That is because of this NFS. Okay. So this NFS, if you see, it gives you the interoperability facility. That is, using whichever bank's ATM, you can go to whichever bank. Even there are even the non-banks also that are running ATMs now, right? So you can go to that also and withdraw money. How is that happening? That is happening only because of this NFS. Okay, that interoperability facility is provided by this National Financial Switch. Now it is being taken care, or it runs under the NPCI, that is National Payment Corporation of India. Next, we are going to discuss about the Payment Vision. So the Payment Vision 2025, it is a document released by the Reserve Bank of India. Okay, on a regular basis, it's released by the Reserve Bank of India. So this Payment Vision 2025, if you see, it focuses across 5 I's. So this is nothing but the strategic plan for the development of India's payment ecosystem. So we know that India's payment ecosystem, it has to be stronger. It has to have the capacity to transfer, or it has to have the capacity to process that huge lakh number of transactions. So all that is required, right? So for that, a strategic plan has been released, and that document is Payment Vision 2025. So there are 5 I's. You have to remember the 5 I's, because one of the banking exams, I'm not sure which banking exam, they had asked which among the following is not one of the I under the Payment Vision 2025. Okay. So integrity, inclusion, innovation, institutionalization, and internationalization. These are the 5 I's. Remember, it is very, very important. Integrity, inclusion, innovation, institutionalization, and internationalization. So these are the 5 I's. And the core theme of this Payment Vision document is e-payment for everyone, everywhere, and every time. Remember the 4 E's also. Payment for everyone, everywhere. So this is the 10 expected outcomes under the vision. Okay, just read this. Okay, I know it is difficult to by heart each and everything, but just read it. Okay, if you read it 5 to 6 times, you can easily remember the half of it itself. So I'll just read it for you once. Volume of check-based payment to be less than 0.25% of the total retail payment, more than 3x increase in the digital payment transaction, UPI to register average annualized growth of 50%, and IMPS NEFT at 20%. Increase of payment transactions, increase in debit card transactions at POS, that is point of sale, by 20%. Debit card usage to surpass credit card in terms of value. Increase in PPI transaction by 150%. Card acceptance infrastructure to increase into 250 lakh. Increase of registered customer base for mobile-based transaction by 50%. Reduction in the cash in circulation as a percentage of GDP. Okay, I know this is difficult, but please read it 5 to 6 times. Okay, they might ask you in the exam. So please read it 5 to 6 times. You will remember. Okay, these percentages and all, it is quite important. So please read it. So now integrity. So we are going to discuss the 5 I's. Okay, first one is integrity. So what is integrity here? It means this is to ensure that the transaction that takes place, it takes place in a very safe and secured manner. Whatever money is intended to transfer, it has to be transferred to the right person. Okay, a fraudulent transaction should not take place. That is the main purpose of this integrity. For that, under that, if you see, various things have been introduced. First is this additional factor authorization, or also called as the two-factor authentication. Additional factor authentication, and also called as the two-factor authentication. So what this two-factor means? It simply means that there should be a two-factor before, that is, two things should be done before making any transaction. Say suppose even in the internet banking nowadays, if you see, if you log in into your internet banking, first you will give your username and then your password, right? And after giving your username password, it will ask, nowadays it asks for an OTP, one-time password. Okay, so that what if some other comes to know about your password? That time they will be able to log in and withdraw the money, right? That is why this extra factor was introduced. That is one-time password. So if you have your phone, then you can enter that OTP and then make your transaction. But now what is happening is that certain things are happening, that the fraudsters, they now have access even to this OTP. So like if something you would have heard about SIM swapping, right? So what happens that they somehow get your default SIM, somehow duplicate SIM of yours, and they try to get that OTP. And using that OTP, they try to log in and make the fraudulent transaction. That is why RBI has told that we have to think about another second factor authentication, OTP. It is now being compromised. So we have to think about a better one, something like biometric. So where your thumb is required. So that time that cannot be fraudulent, that cannot be faked, right? They cannot do that biometric. Similarly, iris also. So using your eyes scanning. So all this can be inculcated. This is just a discussion that is not being given. RBI has not told any banks or any financial institution that this second factor authentication you have to follow. But this is just a discussion that is going on so that it is not compromised. The people are not do not face any fraudulent transaction. Next is legal entity identifier. Okay, so legal LEI is legal entity identifier. This was also introduced by RBI. Okay, so here what is this LEI? So for any transaction that is made by an entity, that is non-individual. Okay, and if the transaction value is more than 50 crore, then that entity should have a legal entity identifier, so that this will be easy for the RBI to track such transactions, to track such huge transactions in the future. Say suppose there is a 65 crores transaction happening, okay, and RBI, due to some other investigation, they found out that the 65 crore transaction, it is a fraudulent transaction. The purpose of the transaction is for some fraudulent activity. If they want to track that entity which has made that transaction, they have to know, right? Say suppose there is an entity called XMI that has made this transaction. There might be also another entity with the same name, right? So it is very difficult. So that is why there might be multiple entities with the same name. So each entity has to have a unique legal entity identifier. Okay. So because you might ask, right? So they have made a transaction. By the name itself, you can find out, right, who it is. But what if there are multiple names with the same, say suppose XMI, and there are so many XMIs in the country. So one XMI has to be uniquely identified, right? Which XMI has made the this transfer? So that is the purpose of this legal entity identifier. That is mainly to able to track the transaction if required by the RBI. So if a entity tries to make a transaction 65 or 70 crores, that is above 54 transaction, without a legal entity identifier mentioned in their RTGS transaction or NEFT transaction, then the bank will reject the transaction. Okay, I am telling it once again. The entity which wants to make 50 crore above transaction, they have to mention this legal entity identifier in their transaction. Otherwise, the bank can reject that transaction. So look at the structure of the legal entity identifier. The first 4 characters, that are totally 20 characters. This is also very important. Okay, they might ask you what is the length of this legal entity identifier. You should know that there are 20 characters. The first 4 characters identifies the local operating unit that issued the legal entity identifier. Next, character 5 and 6 always set to 0. 7 to 18 unique to each entity, and then character 19 to 20 it check digits for the verification. Okay, you have to know there are 20 characters and what each character denotes. The next initiative of RBI under this integrity is ODR. ODR is online dispute resolution. Okay, this is a mechanism which was introduced by the Reserve Bank of India in 2021. That is, it instructed all the regulated entities to have this ODR applicable or available in their internet banking and mobile banking facilities. So what is this purpose of this ODR? Suppose if a customer by mistake has done or involved in a fraudulent transaction. Okay, after conducting the transaction, he gets to know that it is a fraudulent transaction and he wants to report it immediately. So when he is already using the internet banking, if the option is available there, then he will not search anywhere, right? He can immediately report. So that is why, to make it very convenient, and also it has to be, all these fraudulent transactions, it has to be reported immediately. Okay. So it is very important that the time taken to report the transaction is very, very less. That is why RBI instructed all the regulated entities to include this mechanism in the internet and the mobile banking facilities. Next initiative is CPFIR. CPFIR full form is Central Payment Fraud Information Report. Sorry, Fraud Information Registry. Okay, so this, if you see, it is again, this is established by the RBI here. So what is the purpose of this? Here the banks can come and report their frauds. Okay, whatever frauds is reported by the people, that is by the customers to the banks, this is how it works. Okay, people report the frauds to the banks and banks in turn report the frauds to the RBI. Okay, so here if you see, previously this Central Payment Fraud Information Registry, it was only available to the scheduled commercial banks and the non-bank prepayment issuers. Okay, prepaid instrument issuers, only to these entities this was available, and now it has been extended. That is, now it is available to the regional rural banks, the urban cooperative banks. To all these banks this is available, so they can also come and report the frauds in the Central Payment Fraud Information Registry. Next is payee name lookup. So if you see, generally when you do a NEFT or an RTGS transaction, many of the customers, they were ended up sending the money to the wrong account number. Okay, so what happens by mistake, what happens is, instead of 2 they might given a 1, or instead of 4 they might enter number 3. So why is this happens? Mainly because you enter the account number but you are not sure. When this payee name lookup is available, it will be easy for the customer to confirm, right? So when you, what is this payee name lookup? This is especially for the NEFT and RTGS transaction. That is, when you enter the account number, you will have the name automatically populated. Okay, so in the next tab or in the next column, the name of the account number, okay, whoever is holding that account, that name will be populated. So this will help you to cross check, right? So whether if you want to transfer to person A, if you enter that account number of A, then automatically the name A will get populated. So this will ensure that the NEFT and the RTGS transactions which are sent to the wrong accounts, that are minimized, because a lot of NEFT and RTGS transactions, they have ended up in the wrong account number. And what happens when they send a wrong NEFT or RTGS transaction? The customer goes and complains to that bank, okay, and that bank communicates to the beneficiary bank, because these under NEFT and RTGS, the two banks are different banks mostly. Okay, so they go and communicate to the other bank. That bank will go and communicate to the customer. So it is a very long process. And sometimes what happens, the money cannot be returned also when this customer is not in the contactable region. What happens, the money may not be returned to the customer, so customer ends up losing. So when this pay name lookup option is available, it will be very easy for the customer, and the number of wrong transaction will also reduce. That is why RBI suggested this pay name lookup option should be made available by all the regulated entities for the NEFT and the RTGS transaction. Next is PSO. PSO is Payment System Operators. Okay, these includes the card networks, the cross border money transfers. So all these comes under this payment system operators. Okay, so generally how RBI supervise them? They generally supervise them only through off-site returns. So we know that RBI supervises the banks through two things. Okay, off-site and on-site. Off-site is they will support the reports. Okay, the regulated entities, or say even these card networks in a cross-border, they will on a regular basis, quarterly or half-yearly and even annually basis, they will submit the reports whatever is required by the RBI. All these entities will submit. Okay, on-site what happens? The RBI actually sends people, that is the employees of the RBI, they actually go to the entities and cross-check. Okay, so this on-site is very, very important, because in off-site they might send the wrong data. Okay, they might send the fake data. But when you actually go to on-site, you will actually know that they have not reported the correct data. Accurate data is not reported, because what we have seen is in many of the times in the offsite report, especially you would have seen in lot of news, is that in the offsite report submission, they would have sent that NPA is 1 crore. But when you go and visit the on-site, okay, when you actually go and visit the bank, that time the RBI has found that the NPA is not actually 1 crore but 10 crores or 15 crores. Such huge differences were noted by the RBI officials. That is why on-site is very important, and here it is insisted that just off-site returns, that is just off-site supervision is not sufficient. On-site should also be made applicable to all these payment system operators, that is card network, cross-border money transfer. Next is including assessment of RTGS and NEFT under the PFMI. PFMI is Principles for Financial Market Infrastructure. Okay, so this is what is the full form, Principles for Financial Market Infrastructure. If you see, the Reserve Bank of India has adopted this principle for financial market infrastructure. Who has published this principles for financial market infrastructure? Someone has to publish, right? That will then only it can be accepted, right? So this, if you see, two parties together have published this. One is the Committee on Payment and Market Infrastructure. In short, it is called as CPMI, Committee on Payment and Market Infrastructure. Second is the International Organization of Securities Commission. Remember, International Organization of Securities Commission, together they have published these principles. Okay, so under this principles only, all the authorized payment systems, they are supervised by the RBI. So all the payment systems that are operating in the India, they have to follow the PFMI standards. Okay, so here RBI has mentioned that the assessment of the RTGS and NEFT also, it should be carried out periodically, that is on a regular basis under this PFMI standards, and not only just organize it, not only just assess it, but it should also be published. That is, it should be available to the public, because RTGS, NEFT, it is used by crores and crores of the Indian people, right? So if the actual international standard is followed or not, that should be tested, that should be assessed periodically, not just once in a while, but on a periodic basis, and it should also be made public to the it should also be made public. Okay, you should know that RTGS and NEFT, they are owned and operated by the Reserve Bank of India. That is one main point that you have to know. Okay, so here assessment of the RTGS and NEFT on a regular basis, that should match with the standards and also be published. That is, the assessment report should also be published and made public, made visible to the public. Next initiative is explore local processing of payment transaction. Now, what does this mean? So let me explain this with an example. So there is a person. Okay, say suppose you are ordering a product in Amazon. and for the billing purpose, for the payment purpose, you are using a Visa card. Okay, so you will enter all the card details and the payment process, that is the payment process will take place, and then it will be credited to the merchant. Okay, so this is how it will work, right? So what happens here is that here the payment process where all this from your account should be debited and the merchant's account should be credited, all this payment process, it happens in a server, right? So it will happen in the server of Visa, and this server can be located anywhere. That is, you have Visa server is located in multiple places like Singapore, USA, and various places. So this payment process, if you see, it can happen in the countries of any server. Maybe it can happen in the US server or the Singapore server. So what RBI is thinking that the payment process should happen in the server which is present in India. Okay, so why this RBI is planning to insist? Because here, what if the geopolitical tensions is increasing, the tariffs, the US is putting tariffs, then lot of tension is arising between the countries itself. So when the transaction takes place, when the processing takes place within the server that is located in India, then if you see, it will be safe. That is, the transaction will be completed in a safe manner. If it happens in other servers, what if the transaction gets failed, or what if that a country blocks our country? So that is why it is exploring on the option that the payment processing as well as the payment information storage. If you see, now you have entered the card details, right? The card details, they are all stored within India only. Okay, if at all they are stored, they are all stored within the India server only. But only the processing, if you see, it happens outside India. It can happen outside India, and now RBI is thinking that that should also happen only within India because of all these geopolitical tensions. Okay. Next is study creation of digital payment protection fraud. So now the digital payment is also increasing. Okay. So is the digital frauds. So we have seen a lot of digital frauds now, they are increasing day by day, right? And government is also taking a lot of measures to tackle them, to reduce them, but still it is increasing. So they are thinking that why not we develop a fund, okay, to recover the money. What happens is that digital fraud happens, okay. The customer goes and makes a complaint also, but the recovery rate is very less because it is very difficult to track the person who has actually taken the fraudulent money. So the recovery rate is very less. So to tackle such frauds, maybe we should develop a digital payment protection fund for that purpose. So this, if you see, it is still under study. Okay, the RBI has not established the fund. It is still thinking that whether we should develop it or not because of the increasing fraudulent activities taking place in digital fraud. See, I am trying to explain this all with an example so that it will be easier for you to understand and also retain. That is why I am trying to give you a lot of examples. The next pillar that we are going to cover is inclusion. Okay, so under this, what are the initiatives taken by the RBI? The first one is enable geotagging of the digital payment infrastructures and transactions. So here geotagging in the sense, here the digital payment infrastructure mainly means the POS, that is point of sale, then the QR code transaction. This is all digital payment, right? When you go to a merchant's place, say suppose you are going to a food shop. So if you eat something, you can pay it via your POS or by scanning the QR code, right? So these are called as the digital payment infrastructure. So RBI suggested that geotagging should be done. So why this geotagging should be done? So that we know how many POS machines are there in a particular district, in a particular area. So what happens that sometimes when you try to improve the digital payment infrastructure, sometimes you improve a lot in region 1. Okay, say suppose in region 1 there are 100 POS machines. But in region 2, if you see, there are just 5 POS machines. So such a huge disparity exists, right? So to ensure that it is equally distributed, the digital payment infrastructure should be equally distributed across all the regions and the areas in the country. So to monitor that, geotagging should be enabled. Next is transactions. So by geotagging the digital payment infrastructure, we will be able to also monitor the transaction. Monitor the transaction in the sense, say suppose in region 1, a lot of fraudulent transactions is taking place. They keep on reporting the fraudulent transaction. So you will be able to know what is happening in region 1. So you can come down to region 1. So that is why this will be helpful. That is geotagging of digital payment infrastructure and the transactions. Next is revisit guidelines for the PPIs, that is prepaid payment instruments, including closed systems, prepaid instruments. Prepaid instruments. What is prepaid? First of all, what is prepaid instruments? So prepaid instruments, you can load the money into this instrument, can be a wallet or a card or a voucher, and that can be used for various purposes. So this can be used instead of cash. Okay, that was one of the reasons to introduce this prepaid instruments. So if you see, there is called as open and closed, two types. Okay, open and closed prepaid instruments. What is this open and closed? Open means this instrument, it can be used in various places. Okay, but closed, if you see, it can be used in places which are told by the merchant only. For example, say suppose you have bought an Amazon, you have gifted one person an Amazon gift card. So where can this gift card be used or redeemed? It can be redeemed only in Amazon, right? So this is a closed prepaid instrument. That is what is the difference between open and closed. Similarly, there is one more thing called small prepaid instruments and full KYC prepaid instruments. So in small prepaid instruments, what it means that when an issuer, say a bank or a non-bank, when they are issuing a prepaid instrument, whoever is buying it, okay, their information is very limited that they have to get. Say suppose only the ID and phone number is enough. More than that is not required in order to issue a small prepaid instrument. Whereas in case of full KYC, the entire KYC information has to be submitted by the buyer to the issuer. Only then he can get full KYC. So similarly, in small PPI, if you see, there is only small amount can be loaded into this prepaid instrument. Say suppose only up to a maximum of 10,000 rupees can be loaded into this prepaid instrument. But in case of full KYC, a maximum up to 2 lakhs rupees can be loaded into this prepaid instruments. And also in full KYC, you can withdraw or transfer money. Okay. Generally, prepaid instruments, they can only be used in merchants. When you buy some product, you can swipe this prepaid instruments. But in case of full KYC, apart from that usage, you can also transfer money or withdraw money. But in case of small PPI, if you see, you cannot withdraw or transfer. Okay. So these are the various prepaid instruments. Previously, if you see, the adoption level was quite low. That is, people using the PPI were quite low. But now, if you see, it has been increased tremendously. Okay. A huge number of people are using the prepaid instruments now. So the same guideline is not be applicable now, right? So previously, say suppose before 5 years, there were only 100 people who are using the PPI instruments. But now, if you see, currently, say suppose there are 10 crore people using prepaid instruments. So such huge people have adopted this prepaid instruments, right? So now the guideline has to be revised. More regulation has to be done. More supervision has to be done. That is what is mentioned under this. Next is consider framework for regulation of all significant intermediaries in the payment ecosystem. So here, if you see, apart from the issuer and also the buyer, that is the customer, there is also one more person playing in this payment ecosystem, that is the intermediary. So example of this intermediary, if you see, the payment aggregator, the payment gateway, who are they? These are all the intermediaries, right? What do? They connect the buyer and the seller. So in case of Amazon, let us take the example of Amazon itself. The payment aggregator will connect the customer and the merchant, right? That is what is the payment aggregator job. So here, if you see, these should also be properly governed. So already the online payment aggregator, the online payment gateway, they are already governed properly by the RBI. But if you see the offline payment aggregator, they are not as such, they are not as governed as much as the online payment aggregator. Okay, the governance level is quite low there. So that should also be taken into effect. It is the offline payment aggregator should also be taken into effect, and framework should also be developed for this offline payment aggregator. In case of payment gateway, if you see here, what is the payment gateway? They actually ensure that a smooth and a seamless transaction takes place. Okay, that is, your money is debited from your account, credited to your merchant account in a safe and a secured manner. That is promised by this payment gateway. So what technology they have to follow, the technology standard and all, if you see, that is stated by the Reserve Bank of India, and the payment gateway, they have to comply to it. Okay, this is what the RBI sets for them. And similarly, the offline payment aggregator, if you see, what is this offline payment aggregator? So this online payment aggregator, when you buy something in Flipkart or Amazon, they come into picture, right? Offline payment aggregator, say suppose you have visited a merchant's place. Okay, there you do a physical payment. Okay, you are present at the merchant's place and you make the physical payment. In that case, that payment aggregator, it is called as a physical payment aggregator, that is offline payment aggregator. Next is bring in enhancement to the check truncation system, CTS. So say suppose you are owning a small business. Okay, so you have done some service to a client. That client has given you an HDFC check. Okay, of amount, say suppose 1 lakh rupees. You have done some service, and for that you have given the client has given you an HDFC check of 1 lakh rupees because the client has an account in HDFC. But you unfortunately have an account only in SBI. So what do? You go to the State Bank of India, you present the HDFC check to the State Bank of India, give your account details. So the State Bank of India presents the check in the check truncation system. So here the HDFC check is presented. Then if you see it is presented, then the HDFC Bank, the next day only the amount will be credited to your account. Okay, the State Bank of India will present the check today, but the amount will be credited to you only the next day. Okay, so this long the check truncation system takes. So now enhancement should be done to ensure that it happens in a continuous manner. Okay, just like RTGS, NEFT and all, it happens in a continuous manner, right? So NEFT, if you see, it will take just 1 or 2 hours to be credited to your account. Similarly, it has to happen in a continuous manner rather than waiting for a long period till tomorrow. So till tomorrow, if you have to wait, there is settlement risk and also a longer time waiting period. So you have the check, but you're going to get the money only tomorrow. So longer time waiting period, all this has to be reduced, and waste should be done such that it happens, the check truncation, it happens in a continuous manner. Next is extend internal ombudsman scheme to all the payment system operators. So if you see in 2019, this internal ombudsman scheme, okay, it was made applicable to the non-bank PPI issuers, that is prepaid instruments issuers, okay, whose outstanding instruments are more than 1 crore in number, not in value. I'm telling you, if that non-bank prepaid instruments prepaid issuer, okay, prepaid instruments issuer has issued instruments of more than 1 crore, okay, it is outstanding. This presently they are using 1 crore instruments are in use, then they have to follow this internal ombudsman scheme. In 2019, RBI had introduced this to the non-bank PPI, okay, who are satisfying this 1 crore outstanding number condition. So what is this internal ombudsman scheme? So this, they have to appoint an internal ombudsman who takes care of the customer's grievances. So if a customer submits its grievance, his or her grievance, that has to be fulfilled, okay, checked and properly done, completed within a certain time period, right? So that was issued in under this internal ombudsman scheme, so that the customer grievances are properly addressed in a timely manner. So similarly, now RBI should take measures, that is planning to take measures to extend this internal ombudsman scheme not only to such PPI issuers but also to all authorized payment system operators. Okay, not only if you have 1 crore outstanding, it should not be done. Now it should be extended to all the authorized payment system operators, so that the customer's grievances are handled in a timely and an efficient manner. Next is support increase in market trading and settlement house. So what is this market trading? You know, there's something called money market, right? So money market instruments are like T-bills, treasury bills, then the commercial bills, then the certificate of deposits. So all these are money market instruments. Okay. So here they have a certain time. They cannot be traded. If you see, they are not available like after 10 o'clock or 11 o'clock in the night and all, you cannot issue treasury bills. But the current situation, if you see, the NEFT and the RTGS are available 24/7. Previously, if you see, this NEFT and RTGS before few years, they were not available for 24/7. But now they are available for 24/7. So then why can't money market instruments also be available for 24/7? So if it is made available, then what happens is that the price discovery will be better. Okay. So if they are available for more number of hours, the price discovery will be better, and also the efficiency will also be better. So it has suggested that to increase the market trading and settlement hours. Next is upscale customer outreach and awareness activities. So RBI conducts a lot of awareness activities to ensure that customer does not fall into any fraudulent transactions, right? So like EBAT, if you see, electronic bank awareness training program, and this RBA says. So these are the various awareness training programs that are conducted by the Reserve Bank of India on a timely basis. So if you see this, if you see in EBAT, campaign is being conducted in various places. But now if you see, the number of digital frauds are increasing tremendously. Okay, so more effort should be done by the Reserve Bank of India, and now RBI is planning that instead of just having the campaigns in particular places, maybe we should improve the campaign space in more areas. That is, we have to conduct campaigns even in the bank branches, even in more social medias, so that it reaches a lot number of people. Already RBI says, if you see, you would have seen a lot of ads in the televisions, right? That is already in function. And similarly, now already the RBI is sending RBI WhatsApp messages. So ensure that you do not fall as a trap, as a prey into this fraudulent transaction. So this is an initiative to increase the customer outreach and the awareness activity. Next is revisit scope and usefulness of Payment Infrastructure Development Fund PIDF scheme. Okay, this is PIDF is Payment Infrastructure and Development Fund. What this scheme does is it provides subsidy to the merchants who deploy the payment POS, that is POS or QR code, the digital payment infrastructure, whichever merchants deploy them, that subsidy is provided to those merchants. Okay, that is the purpose of this PIDF scheme. So if you see, this is especially concentrated to the tier 3 to tier 6 centers. Tier 3 to tier 6 centers is particularly concentrated, but few beneficiaries from tier 1 to tier 3 or tier 1 to tier 2 are also covered. Okay, I'm telling it once again. This PIDF scheme is mainly for the beneficiaries located in the tier 3 to tier 6 centers, but only few beneficiaries, few type of beneficiaries are covered from the tier 1 to tier 2 centers. So when they purchase this POS or the QR code, certain subsidy amount will be provided to the merchants. This is to increase. Okay. So this has a time period. That is, this scheme will be applicable only till 2025 or 2026 and all. That's a time period. So now they're thinking that this has to be revised. That is, more beneficiaries has to be brought in, or more centers it has to be expanded, or the timeline. So since many people are now adapting to it, so maybe you have to increase it for 1 more year or 2 more year, or this is being revisited. Next, attempt regulation of the big tech and fintech in payment space. So we know that the fintech companies, they are playing a vital role, like the GPay and all. If you see, now you don't even have to visit the bank to avail for a loan. You just have to have the GPay. GPay itself sometimes will notify that you are eligible for so and so loan amount. You can avail it just sitting inside your house using a GPay alone. So the fintech company, they are playing a very vital role in providing the various credit products, right? So what is that? Since they are now playing a very vital role, the amount of regulation also should be proportionate to that. Okay. So a discussion paper on the need for proportionate regulation by the Reserve Bank encompassing domestic incorporation, reporting, data usage, etc. shall be published. Since their importance has been increasing, since their usage has been increasing, so the regulation should also be increased proportionately. Next is continue endeavor to collect and publish granular disaggregated payment system data. So RBI, if you see, they publish the granular data, that is detailed payment system data, like how people are making payments. Suppose in this month, how people made payment, whether by UPI, credit card, debit card, or net banking. If UPI, that how much percentage of entire transaction has been done by UPI, debit card, all this is properly analyzed by the RBI, and that is also published. Previously, if you see, there would be a huge lag between the collecting data and publishing data. Like for example, I'm telling you that today, suppose it is first, they have collected the data, but they might publish it only after 3 months. So such huge lag was there. But now it has been reduced very tremendously. Okay, that is, the lag between collecting and publishing data has been reduced tremendously, and RBI is working on it to reduce it even further. So continue endeavor to collect and publish data, and also reduce the publishing time or the lag. Next is make payment systems more inclusive. So what does this mean? So just like the notes are made more inclusive. More inclusive means this should be easily accessible even by the differently abled people, the visually impaired people. They should also be, they are also a part of a society, right? So they should also be able to access it even more easily as how we access it. So for the visually impaired people, you know, if you see the notes, the currency notes that are printed by the RBI, that will be sort of raised. So you can feel the letters, you can feel the numbers. So from that, a visually impaired can actually identify whether it's a 10 rupee note or 20 rupee note or not. Similarly, even the payment systems, the UPI systems, and even the other various payment systems, they should also be designed in such a way that it is easily accessible by the differently abled or the visually impaired people. So that is what it means, that making payment systems more inclusive. Next is undertake evaluation of charges for all payment systems. So here what happens is that the UPI, or even say suppose that you are using a credit card, okay, you go to a merchant, you buy some product. So you swipe that card and you make the payment. Sometimes what happens, there is a MDR charges that are applicable. What is that called? Merchant discount rate. Okay. So on the transaction that you made, on the swipe that you do on the POS, there will be a merchant discount rate, maybe 0.1% or 1% that will be charged. Okay. Say suppose it is the Visa card. So they actually process the transaction, right? They use their server to process the transaction. So here server is used, electricity is used. So they try to recover that money in the form of NDR. So the MDR, the merchant discount rate, or any other service charge that has been applied on a digital transaction, it has to be such that it should not deter the digital transaction. It should not be so high that it should not discourage people from using the credit card. Say suppose the charge is some 10% on your entire amount, purchase amount, then how will people use it, right? It is very huge, right? It will deter, it will discourage people from using such payment system. So they have to undertake the evaluation, that is continuously the RBI should evaluate such that the charges are not so high. So how will they know? That is by evaluation, that is looking into the market and continuously monitoring the charges that are taken by these payment systems. The next pillar is innovation. So let us look into the initiatives under the innovations. So facilitate framework for the Internet of Things and context-based payments. So if you see first initially how we used to make payment via the cash, then came the debit cards, then the credit cards, then the UPI. Even in UPI you have to scan. Now you can also tap and pay in the credit card. So it kept evolving, right? So the devices kept evolving, some from solid cash to the cards and now to the mobile phones. So similarly, if you see here, there is also one more thing, that is Internet of Things. Here it is talking about the smartwatches. The usual thing that you actually use on a daily day-to-day basis, like in watches also. So you can make payments now using your smartwatch. So now if you see, since a lot of payment devices like the smartwatches are evolving, now we have to create a framework for that. For securely the transaction is completed, and also for secure payment, ensure that the payment has been completed, ensuring that only the authenticated payment has been done. So for that, a framework has to be created. So with a view to promoting growth of this segment and at the same time protect customer interest and enabling framework on the Internet of Things based payments, covering aspects of data security, authentication, identity validation, etc. shall be facilitated. So if you see all UPI, credit card and debit card and all, you have framework that will ensure the authentication, that will ensure the identity validation and all, right? So if you see in the internet net banking and all, if you see, you have two-factor verification, that is you have to enter your password. After that, there will also be an OTP verification. So two-factor verification is there. So that has a proper framework, proper security system. But now if you see, since these things are also, these payment systems are also being widely used nowadays, a framework should be established for such things. Next is migrate all RBI operated payment system messages to the ISO 2022 standard. So what is this? See, if you are talking to me, say suppose I know only French language. Okay, I am from France and I know only French language. And you are from Germany, so you know only German language. So how will we communicate to each other? Okay, that is a proper common language should be there, right? Only then I will be able to understand what you are trying to convey and you will also be able to understand what I am trying to convey. So previously, if you see, our India, it was a closed economy. Okay, so mostly the transaction took place within the economy. Now if you see our economy, it is an open economy. Okay, so which means that a lot of cross-border transaction takes place. That is, money is sent from a bank in India to a bank outside India. So a lot of cross-border transaction takes place, especially to export, import, and also outward remittance, inward remittance, and all takes place. So here, if you see, apart from when you send message, when you try to send money to another bank, a message is also sent. Okay, you try to send money from your account to another account, but simultaneously the bank will send a financial message to the other bank to which the money is being sent. Okay, so in that financial message, there will be the account number, the amount that is being sent, the receiving account number, everything will be present in that message. So that message should have a standard format. So here what they are telling is that all the RBI operated payment system like the RTGS, NEFT, IMPS, everything if you see, they all should send message, that is transfer messages according to this format, that is ISO 20022 standard format. So this is the global format and we should also operate using this format only, so that even when you are trying to send message abroad, okay, to other bank outside India, that will be understood. Similarly, when they try to send message, they will also send the message in this format. So the communication will be easy and no gap will be there. Okay, that is what is mentioned here. That is to follow the latest format, that is ISO 20022 standard. So ISO 20022 is a global standard for sending payment messages. RBI is going to upgrade all its payment systems to use this new ISO 20022 format. So how will this help? Talk easily with the international systems, be more reliable, support the cross-border payments, catch fraud better. This is the main reason that RBI is planning to adopt this standard. Next initiative is link credit cards and credit components of the banking products to the UPI. So this, if you see, it is already in practice now. So initially, if you see, only the account numbers, that is the savings account, only that can be linked to the UPI. But now if you see, few banks, they are offering that even the credit cards can now be linked using the UPI. So you don't actually have to have the credit card to make payment using the credit card. If you link your credit card with the UPI, you can just make the payment via the UPI itself. So to offer more avenues and greater convenience to users in making payment through the UPI platform, feasibility of linkage of credit cards and credit components of the banking products to UPI shall be explored. So already it is in practice, new credit components. So if you see credit card, we know that they have been linked, right? So credit components also. So pre-sanctioned credit limits are now being explored, are now being available in the UPI. So this is also being developing. Next is create payment system for processing online merchant payment using internet or mobile banking. So what happens here is that nowadays, say suppose you are trying to purchase a product in Amazon. Okay, so you go and hit the payment button. So money, if you see, you make a payment. Okay, either via net banking or credit card, debit card or UPI. You choose one method and you make a payment. Generally, what happens then? The customer makes a payment. The money goes to the payment aggregator account. Okay, it is also called as the escrow account. Okay, and from this escrow account of the payment aggregator, then only it goes to the merchant account who has actually sold his or her product to you. Okay, so this is how it happens. This is how the money travels. So generally, if you see, it takes 2 or 3 days for the merchant to receive his amount. That is because of the agreement between the payment aggregator and the merchant. So RBI is saying that we should plan such a payment system such that this amount transfer is continuous. That is, it is continuously or immediately credited to the merchant account. That is what is mentioned under this. So all merchant payment transactions done using internet or mobile banking are presently processed through the payment gateway or the payment aggregator. As this practice entails delay settlements, a framework shall be introduced such that these transactions are also processed through a payment system. Next is organize payment innovation contest and hackathon. So already RBI recently Harbinger, before 2 years only, Harbinger was launched, right? The first global hackathon, and it was a very huge hit. And RBI is also conducting every year a new edition of this Harbinger hackathon. So more and more things are conducted. So RBI's first global hackathon, Harbinger 2021, okay, efforts shall be it was a huge success. So now efforts shall be continued towards organizing national and international payment hackathons, competition and conferences to foster innovation and exchange of ideas. So generally what happens in a hackathon, existing problems are listed, okay, and the new financial entities or the banks and all, they will come with a new innovation. That is how this problem can be tackled. If this problem is already been tackled, how can we tackle it even more in a better way? So all this is discussed in this Harbinger, and new solutions are introduced. So this should be encouraged. More organized national and international hackathon should take place so that new ideas are brought in. Next is review need for multiple payment identifier. So here if you see, if you want to transfer, say suppose you have an SBI account and you want to transfer your money to another SBI account. In that case, account number itself is enough, right? Nothing else is required. But if you want to transfer from SBI to HDFC account, okay, either a NEFT or RTGS or an IMPS. In that case, if you see, apart from the account number, one more thing is required, that is called as the IFSC code. That is Indian Financial System Code. Okay. So now it is an identifier, right? So that is two identifier. One, account identifier to identify the account of the person. Second, the IFSC code to identify the branch of the bank. So now if you see, why do we need multiple identifiers? They're telling that account numbers of each banks are different. So why do we need this extra account identifier? Why can't just the bank account number alone be sufficient? That is what is mentioned here. Fund transfers through RTGS, NEFT and IMPS require the beneficiary account and the IFSC code, okay, as identifiers. So as bank account numbers in each bank are unique, funds transfer could be facilitated without the IFSC of the beneficiary branch. So this should be reviewed. Next, explore guidelines on the payment involving buy now, pay later. Okay, so buy now, pay later, how it works. See, there is a customer. He has bought and he has gone to Amazon payment page. In that, he chooses buy now, pay later option. Okay, from the name itself, you can guess that you can buy the product now and make the payment later. Okay, that is what this means. So when the customer clicks buy now, pay later, what happens that this BNPL provider, okay, this buy now, pay product, whichever entity is providing this product, this entity will make the payment to the merchant. Okay, so this BNPL will make immediate payment to the merchant. Later on, the customer will make payment to this entity, that is the entity which has provided this buy now, pay later. Most of the times what happens is the payment aggregator itself provides this facility. Okay, so since this is being used, okay, this is a very good opportunity, this is a very good frequently used payment option by the customer. So guidelines should be developed on how this payment is made, whether it is made securely or not. So guidelines should be made created for this buy now, pay later service. So this novel method shall be examined and issuance of appropriate guidelines on payments involving buy now, pay later shall be explored. Next I is institutionalization. Okay, institutionalization is the next type. An initiative under that is first one, comprehensive review of the legislative aspects of the Payment and Settlement System Act provision and regulation. So we know that the Payment and Settlement System Act, it was established in 2007. Okay, way back. So when it got passed, no, the digital payment system in India, it was just in the rudimentary stage, that is only in the beginner stage or the primary stage. So then the digital payment system was nascent, okay, just at the beginning stage. But now if you see, it has evolved so fast, so dynamically. So now if you see, the same act, same provisions, same regulations cannot be utilized. So that also should be reviewed on a regular basis because the digital payments are evolving at a very fast manner. Next, constitute Payment Advisory Council to assist the BPSS. BPSS is Board for Regulation and Supervision of Payment and Settlement System. Okay, there is a board to supervise this payment and settlement system. Okay, now to assist this board, a Payment Advisory Council should be there. And this Payment Advisory Council should have members from various other field. Like if you see, to assist this payment system board, a Payment Advisory Council with experts representing consumer groups, payment technology, legal, bankers, fintech, data analysts, everyone should be present so that accurate decisions are taken. They actually know what is happening in the environment. So it will be very helpful for this board, and also this PAC will also be able to give the accurate advices. So the composition of the PAC shall be reviewed periodically and suitably modified to maintain its relevance. So once it's formed, it's not that you should just leave it. Okay. Even after this Payment Advisory Council is formed, this has to be reviewed periodically. Whether a new member should be added. If you see like 10 years or 15 years back, I'm sure data analysts would not have been added in this if the Payment Advisory Council was created 10 or 15 years back. So this data analyst is being added, right? Similarly, startups also. So maybe in the future after 5 years, some other new entity can also be added if they are relevant. So this has to be reviewed periodically. Next is operationalize national card switch for card transaction at the POS and resultant settlements. So presently, if you see a card transaction at the ATM, say suppose you are trying to withdraw money. Okay, you have an SBI card and you are trying to go to the ICICI ATM, and there you are trying to withdraw the money. Okay, so when you try to withdraw the money, what happens is that national financial switch comes into place. Okay, national financial switch or the ATM network, they come into play. So they only will contact the other bank, and then they'll check the balance, and then you can withdraw the money if there is balance in your account. This is how it works. Okay, when you try to withdraw money from another bank's ATM, this is how it works. So it is all connected to this national financial switch, or it is there ATM network is there, or sometimes what happens that these transactions It is also processed through the concert card network. So if you're using a rupee card, the rupee card network will process the transaction. So like that, there are multiple players who are involved in processing this ATM transaction. But in case of when you try to make a transaction in the POS terminal, okay, in the POS terminal using a card, when you try to make the transaction, only one person is involved in processing the transaction, and that is the card network. So if you are trying to withdraw, trying to make a transaction of 100 rupees using your MasterCard, then the MasterCard will only process the transaction. So this, they're telling that just depending upon the card network, it is not sufficient. We should also have something called national card switch, just like this national financial switch for the ATM processing. Okay, so the possibility of implementing a national card switch to process the card transactions at the POS terminals. So we have to try ways to develop the national card switch to process this transaction and not solely depend just on the card networks. Next is active engagement and involvement in the international forum. So our India should constantly present itself in the international forum. Just like if you see in 2023-24 G20, India was heading the G20 presidency. So when it was heading, it tried to initiate a lot of activities, especially in the financial, like various the UPI was connected with the fast payment system of various other countries. Okay, UPI was trying to be made globally available. So actively participation of India in the various international forum is required. Similarly, even if the international other countries also bring in new digital payment transactions or digital payment methods, we can also incorporate it. Just like if you see, we are trying to incorporate the ISO 20022 standard for the payment transactions, for the financial communication between the banks. Similarly, they will also try to inculcate our practices in them. So it is very important that India should participate regularly and also engage in this international forum. The last I that we are going to discuss is internationalization. So here, first initiative is global outreach of RTGS, NEFT, UPI and the RuPay cards. So if you see, already the UPI is being used worldwide. Okay, many countries, they have tied up. So they are also inculcating UPI in their payment systems. So now RBI is saying that we should also expand the RTGS NEFT that we are using in India. So the feasibility of expanding RTGS to settle transactions in major trade currencies such as USD, Pound, Euro shall be explored through bilateral or multilateral arrangements. So if you see, already such NEFT payment is there. If you see, there is a NEFT related payment with the Nepal. So the Indo-Nepal Remittance Facility Scheme. So I hope you have heard about this. So this was launched in the year 2008 by the Reserve Bank of India. So here if you see, you can do NEFT payment to a person who is in Nepal, to a bank which is located in Nepal. So for cross-border remittance from India to Nepal using the NEFT system, that is using our India's RBI's NEFT system, you can make payment to the Nepal. So if you see, previously the limit was just 50,000 and now it has been raised to 2 lakhs to boost trade payments between the two countries and also to facilitate person-to-person remittance electronically to Nepal. Ceiling per transaction was increased from 50,000 to 2 lakhs. So per transaction limit was, if you see, 50,000. It is now increased to 2 lakhs. And also previously there was a cap that maximum 12 remittance can only be made in a year per remitter. Okay. So if you see, if I am the person trying to send money to a person residing in Nepal or who has an account in Nepal, then I can send only 12 remittances in 1 year, not more than that. But now this cap has also been removed to encourage this Indo-Nepal payment. So similarly, just how we have established this NEFT related facility with Nepal, we should also try to establish the RTGS and NEFT facility with other countries also. That is what is mentioned here, internationalization, first initiative. Mainly internationalization means that is to utilize the INR rupee in various transactions. If you see, if you want to buy products from the other countries, okay, or if you want to sell products also, major currency that is being used in any trade settlement is dollar, right? So now we should also improve our INR. Okay, we should also encourage other people, or we should make methods such that other people trust our INR and also start using their INR in their trade settlement. That is what is internationalization means. Next is expand SFMS and Infinet framework across the jurisdiction. So Infinet full form is Indian Financial Network. What is this Infinet? It is a private closed network. Only members like RBI, banks and the financial institutions only have access to this network. Okay, it's a private, safe and a closed network. So this is used to send secure financial messages using a special application. So it is a network where the RBIs, the banks and the financial institutions talk. Okay, talk in the sense they send financial messages. So what is this SFMS? SFMS stands for Structured Financial Messaging System. So this is an Indian version of SWIFT. It is used for securing messaging between the banks. So if any bank wants to send message to another bank, then this is sent to this this is sent through this SFMS, that is Structured Financial Messaging System. Now you might be getting confused between Infinite and SFMS. In both the cases financial messaging is being done, right? Then what is the difference between them? I will explain this with a very simple example. Say suppose you are using a mobile phone. In that you will have a Wi-Fi, right? And then you will have a WhatsApp. Okay, what is WhatsApp? So you will have WhatsApp. So WhatsApp is a messaging platform. Wi-Fi is a network. Okay, so mobile network or a Wi-Fi network. It is a network. Only when you have a network, you can send this WhatsApp message. So WhatsApp is equal to SFMS, and the mobile network or the Wi-Fi, that is equal to this Infinite. So I hope you have understood the difference between the Infinite and the SFMS. RBI is trying that this Infinite it is a framework, right? So maybe we should show it to other countries so that the other countries can also adopt this in their local payment, in their domestic payment. So it is trying to expand this SFMS and Infinite networks across various jurisdictions. Next is two-factor authentication for cross-border transaction. So we know that there's a two-factor authentication when you want to send money through the net banking, right? So you have to give your password and next the OTP, that is the second factor authentication. So similarly, the two-factor authentication should also be present for a cross-border transaction when you want to send money across the borders. So to give a familiar experience and increase the safety of international transaction done using cards issued in India, implementing the additional factor authentication for the cross-border transaction shall be explored. Next is seek inclusion of INR in the continuous linked settlement. What is this continuous linked settlement? So this CLS, if you see, it is a global system that safely settles foreign exchange rates. Okay, to settle the foreign exchange rates, this CLS is used. So this uses a payment versus payment method, which ensures that both the sides of the forex transaction are settled simultaneously. What happens in this forex trade is that they all operate in a different time zone, right? Time zone for the Japan Japan forex trade is different. Similarly for India, similarly for US, the time zone is different. So when India makes a remittance, it's not the same time that Japan also makes a remittance, right? The time zone is different, so the time they operate is different. What happens is that suppose if India makes a payment, but that payment does not get credited to the Japanese banking system due to some time zone difference or a banking system failure. So in that case, it is an unnecessary risk, right? So unnecessary risk, right? And that risk, if you see, it is named as Herstat risk. Okay, remember the risk name? It is Herstat risk. This helps eliminate this CLS. Okay, this CLS helps eliminate the Herstat risk. That is the risk that one party in a forex deal delivers the currency but doesn't receive the other in return due to time zone or the bank failure issue. So this is what is the main thing. CLS, they help eliminate the Herstat risk due to the time zone. What happens? One party will deliver, but the other party will not be able to deliver it, and because of that, this Herstat risk might arise. Okay. So to avoid that, the CLS comes into the picture. So if we see in India, the CCIL, that is Clearing Corporation of India Limited, it acts as a third party member of the CLS. So this CCIL, it aggregates the forex trade on behalf of the Indian banks and settles them through the CLS. Okay. Now if you see in this CLS, there are various currencies. Okay. Currently CLS supports major currencies like the Euro, USD, Yen and all for the cross-border settlement. But India is not part of it. That is, CLS does not support Indian currency. So here if you see, IND is not yet included in CLS, and RBI is planning to initiate talks to get INR accepted as the CLS currency, because this is one of the important things to be done for promoting INR as a as an international rupee or as for internationalization. Next is bring further efficiency in payment processing and settlements on introduction of the CBDC, domestic and cross-border. We know that already the central bank digital currency has been introduced by the Reserve Bank of India, and there are two types of CBDC. One is the retail CBDC, another is the wholesale CBDC. So retail CBDC, you and me, normal people can access, and wholesale is especially for the entities like the financial institution in order to make huge transactions, huge deals. This wholesale is being used, and this has already been used in the domestic purposes. Now, furthermore, initiatives are being done to use it for the cross-border transactions also. So now we have covered all the 5 pillars of the Payment Vision 2025 and also the initiatives taken under each of the pillars, right? So now you have to have an idea. So if any say descriptive comes on the internationalization, then you can use these things that for CBDC already has been introduced, and RBI is taking various measures to include in this continuous link settlement, because many people may not be aware of this continuous link settlement. So if you try to include such unique points, it will fetch you more marks. Okay. So please try to remember the concept. You don't have to, there are no data related questions from this. Okay. So objective related questions, it's very rare to come from this, but you can use this in your descriptive answers. Moving to the next important function of RBI, that is foreign exchange management. So here if you see the regulation, the management of the foreign exchange transaction, all this is taken care by the Reserve Bank of India. The Reserve Bank of India is the one who stores the forex reserves of the entire country also. So various functions, if you see, it involves monitoring, controlling and supervising the flow of currency. Next is exchange rates. It continuously monitors the exchange rate, especially the dollar and the US rate. Especially in the dollar and the INR rate. So when the INR depreciates, it comes into the picture by ensuring that the dollars are abundantly available in the system. That is, ensuring that the demand is equal to supply so that the INR does not depreciate further. Okay, so always the RBI tries measures or implements measure to maintain the value of the INR. Next, ensuring the stability. As I told, ensuring the stability of the domestic currency, facilitate international trade and payments. And next is maintaining the overall health of the economy. This is what is covered under the foreign exchange management of the Reserve Bank of India. So what does RBI do in foreign exchange regulations? First is exchange control management. So it will set rules and guidelines regarding the permissible limit for the foreign currency transactions, foreign investments, external commercial borrowings. So if you see there, the FDI limit in various sectors, that one, if you see, it is set by the Reserve Bank of India, and also the LRS, Liberalized Remittance Scheme, right? The outward remittance, $250,000 per year is only permitted. All this is set by the Reserve Bank of India. Next is Foreign Exchange Management Act, okay, FEMA. In short, it is called as FEMA Act 1999. So this provides the legal framework for the foreign exchange transaction in India. So this is administered by the Reserve Bank of India. Next, authorizing the authorized dealers. See, there are so many financial institutions, banks in the country, right? Not all financial institutions are authorized to conduct the foreign exchange transaction. So if you go and give dollars, if you want rupee in return, not all banks or financial institutions provide that feature. Okay, that certain authorized dealers can only do. Okay, banks can also be authorized dealers, but you have to have special permission, or you have to get the grant from the Reserve Bank of India. Okay, the Reserve Bank of India designates certain banks as the authorized dealers who are permitted to deal in the foreign exchange transaction. So if an entity wants to become an authorized dealer, then what it has to fulfill? Everything, if you see, it is given by the Reserve Bank of India. So they have to submit the request to the RBI, and RBI has the right to approve or reject it accordingly. So authorized dealers can only conduct this foreign exchange transaction, and who appoints this authorized dealers? It is the Reserve Bank of India. Next is monitoring and reporting. So it monitors the foreign exchange market if there is any abnormal movement or speculative activities and all. Because sometimes speculative activities happen just so the people try to gain profit from that, right? So it continuously keeps on monitoring that, and also they publish. So RBI, if you see, on continuous basis, it publishes the foreign exchange reserves report, like how much forex is held by the Reserve Bank of India and in what form. If it is like $500 are preserved, means in $500 in the US dollars, in the Canadian dollars, in the yen form. So all this in detail, if you see, it is published by the Reserve Bank of India, and public can go and view it also. So it is published to the so that the public can come and view that what is the forex reserve maintained by in our country, in what form. All this can be seen even by the public. Monitoring and reporting function is also done under this foreign exchange regulation by the Reserve Bank of India. Now, what is foreign exchange reserves that the Reserve Bank of India holds? Okay, so this foreign exchange reserves, it refers to the assets held by the central bank, typically denominated in foreign currencies such as US dollar, euro or yen. Okay, so in this form, the Reserve Bank of India holds the foreign exchange reserves. So if you see, a foreign exchange reserves denotes how strong that economy is. So if you see recently, our neighbor country Pakistan, they have mentioned that they have reserves only to cover the next 2 weeks or 3 weeks of imports. But in the recent monetary policy committee held by the Reserve Bank of India, this timeline that I'm talking is June 2025. Okay, so June 2025, the monetary policy committee took place. So in that meeting, the governor mentioned that we have enough foreign exchange reserves that is good enough to cover our 11-month input. So when you import things, obviously you have to make the payment in the foreign currency, right? So we have enough foreign exchange reserves that can cover our 11 months import. So this is a very good amount of, that is very strong amount of foreign exchange reserves. So the amount of foreign exchange reserve if you have, that will create a confidence not just in our country, but also the other countries will also increase their confidence in our country. So it is very important to have a good amount of foreign exchange reserves within our country, and the Reserve Bank of India in our country manages the foreign exchange reserves. So this foreign exchange reserves, apart from the import purpose and all, if you see, it is very important to maintain the currency stability. The foreign exchange reserves help stabilize the domestic currency value in the foreign exchange market. So how does this happen? And recently, if you see, our rupee has depreciated a little, but it was expected to depreciate further. It had stopped by the Reserve Bank of India, that is intervened by the Reserve Bank of India. RBI intervened in the market. Okay, since the dollar was short in the market, what RBI did was that it increased the supply of the dollars in the market. So by increasing the supply, what happens is when the demand is equal to supply, then the value will not increase much, right? So when the RBI made sure that there was enough supply of dollars in the market so that rupee does not depreciate further. Okay, so to ensure that your currency does not depreciate, to ensure that your currency is stable, what you require is a lot of forex reserve. Only when you have enough amount of forex reserve, you can deploy that reserves into the market. If you don't have that enough amount of forex reserves, you only have to cover the imports, then you cannot deploy in the market. You cannot intervene in the exchange market. And what happens ultimately, your currency depreciates further. So when the currency depreciates a lot, what happens? Other countries do not have confidence in you. They lose the trust in you. So currency stability is a very important thing, and the holding strong amount of foreign exchange reserves helps in stabilizing the country's currency. Next, international trade and payment. As I said, if you make an import, you obviously require to make the payment in the foreign currency. So adequate foreign exchange reserves ensures that the country can meet its international trade obligations, including import payments and servicing of foreign debt also. So you, as I said, you require money to make import. But one more thing that is very important is, obviously all countries, they borrow. Okay, every country, they have a debt. Even the largest country, strongest country in the world, that is the US, also have a lot of debt, right? Only with debt you can grow. So you require for a foreign currency to make interest payments for foreign debts. So if the country has borrowed $100,000, then they have to make an interest payment again in the dollars itself, right? So for that, you require forex. So when you do not have the forex reserves, when you do not have enough forex reserves, then when you go and approach for foreign debt, no one will be able to give it to you because you do not have the reserve to make the interest payment itself. Then how will they give you a fresh debt? So for that also, the forex reserve plays an important role. Next, crisis management. So foreign exchange reserves act as a buffer during times of financial crisis or economic shocks. They provide a safety net to mitigate the impact of external shocks such as capital outflows or sudden currency depreciation and help restore the market confidence. This we have already covered in the previous points. Next, we are going to see RBI's function is consumer protection and financial education. This is also one of the important role of RBI. Okay, so RBI, if you see, it conducts various camps, it issues various booklets in which it mentions about the consumer financial education, how consumer has to be aware about all these things. Okay, and now since we are in the digital era, now if you see, already the RBI is sending WhatsApp messages, sending advertisements in the, or creating ads in the TVs, so in the YouTube also. So now if you see, now it has moved to the digital part of financial education. So Consumer Service Department under the Reserve Bank of India, if you see, the main function of it is to dissemination of instruction or information relating to the customer service and grievances redressed by the banks. So it tells the banks, the RBI tells the bank that how you should treat the customers fairly and give them proper information. Do not hide any information, do not misuse the customer. And also if the customer raises any grievances, you have to address it within this proper timeline. The timeline is also set by the RBI. Everything is set by the Reserve Bank of India. It also oversees the grievance redress mechanism in respect of services rendered by the various RBI offices and departments. So apart from the grievances raised by the banks, it also checks on the grievances that are rendered by the various RBI offices or departments. Okay, so especially if you see, when a customer is not satisfied with any service, they first approach the bank. Okay, they first approach the bank, raise the complaint, and if the bank does not respond to the complaint within 30 days, or they respond to the complaint but the customer is not satisfied. Okay, if the customer is not satisfied with the reply, then the customer can go and approach the Reserve Bank of India. And then the Reserve Bank of India then will look for the solution and then it will provide the solution to the customer. Okay, so these grievances are handled by the Reserve Bank of India also. So after the grievances are not satisfactorily handled by the bank, then if you see, if that grievances is passed on to the Reserve Bank of India, the Reserve Bank of India handles those grievances also. So it also acts as a nodal department for the banking codes and the Standards Board of India. What is this banking codes and standard boards of India? So this, if you see, it is an independent body. So they develop volunteer codes and standards for the fair treatment of customer by banks. If you see, if you visit the branches of any bank in our country, they have to display this board. It will be there in the display for customer viewing. Okay, so it contains all the standard treatment or the fair treatment of the customers that the banks have to provide. So it apart from that, they also monitor the bank's adherence to these codes, whether like it is not just enough if you display the board, right? You have to follow it, you have to implement it. So the body also ensures that the banks implement those codes, and it also protects customer in the banking sector. Next, it acts as a liaison between the banks, Indian Bank Association and the offices of Banking Ombudsman. Next is Deposit Education and Awareness Fund. What is this DEF? You must have surely heard about this DEF. This is nothing but when a customer does not use his savings account or the current account for around 10 years. Okay, if the account remains inactive for around 10 years, then what happens is that the bank will transfer this account to the RBI. So under the RBI, it will be stored under this DEF. Full form is Deposit Education and Awareness Fund. Remember the full form is very important. So under this DEF, all this inactive accounts, that is, they are also called as unclaimed deposits. Unclaimed deposits, that is when they are not touched for 10 years, then all these unclaimed deposits, they are transferred by the banks to the RBI and they are maintained under a fund called Deposit Education Awareness Fund. Okay, so since this is already transferred to the RBI, can the customer in future not at all get it back? No, of course they can. So if at all the customer after 12 years or 13 years comes to know about this account, they can approach the bank, give the required KYC details, and then the bank will request the RBI and the RBI will transfer the fund from the DEF to the customer's account. Okay. So now if you see recently what happened is this, a lot of amounts started accumulating in the DEF fund, which means a lot of unclaimed deposits started increasing and they all got transferred to the DEF. So RBI is trying various measures to reduce the DEF. Okay, so what is this DEF fund actually? These are all the money of the people, right? Might be what happened, why are they not claiming? It might be because they have lost their account details, or it might be their fathers, the father would have passed away and the son would not have known about the account detail itself. So these might be a lot of reasons, right? So to make it easier to claim back the unclaimed deposits, the RBI has launched a portal. The portal is Udgam portal. Okay, so here the full form is Unclaimed Deposits Gateway to Access Information. I am repeating it once again, Unclaimed Deposits Gateway to Access Information. So here using your PAN or mobile number or your driving license, okay, so using your IDs, you can search and check if there is any DEF account, if there is any unclaimed deposit associated to this account available in this portal. Okay, and also if you see, the banks they also assign a number to these unclaimed deposits, that is unclaimed deposit reference number. Okay, unclaimed deposit reference number is assigned to each of these accounts so that it will be easy for the banks to track it. So customers, they can go and approach, if they have found anything in this portal, they can go and approach the respective bank, and the bank will do the proceedings. So RBI is taking various measures to ensure that the unclaimed deposits go back to the customers. Next is RBI's role in economic development. So if you see especially the private sector lending. So here to ensure that the entire economy, it is not just the industries, not just the HNI has to develop, the entire economy has to develop, and that is why RBI had implemented the private sector lending. And under the private sector lending, there are various categories like agriculture, MSME, export credit, education, housing, social infrastructure, renewable energy. Okay, these all the private sector lending topic would be covered in detail in the other chapter. Here you just remember the categories under the private sector lending. Okay, so how much, under agriculture, how much amount should be allocated to the agriculture, how much amount should be allocated to the MSME, everything is covered in detail in another chapter. Don't worry, for now you just remember the categories under the priority sector. Next, financial stability and system risk regulation. So this is also a function of RBI. So if you see, RBI continuously performs the risk assessment. Okay, so it continuously monitors various risks faced by the banks and the financial institutions such as credit risk, liquidity risk, market risk, operational risk. So I'm sure you know everything about, what a credit risk, liquidity risk, right? I'll tell you in one line if you want. Credit risk is nothing but when you provide a loan to a customer, and if the customer does not pay back, then a credit risk occurs. Next, liquidity risk is when the bank does not have enough fund. So whenever the bank should have enough fund to ensure that whenever a depositor comes and asks for money, the bank should be able to give the money back. Okay, but if it does not have enough fund to give back the money that it is liable to, then it is facing a liquidity risk. Next, market risk is just like you and me, we invest in various financial instruments. So does the bank. So they also invest in various financial instruments, treasury bills and all, right? So that if at all those instruments, the value comes to zero or the value depreciates very much, then a market risk occurs. Next, operational risk, it is caused by the system risk. Okay, if there is any software misuse, if anyone has hacked the system, so that might be a system problem, or due to the employees. Say suppose the employee by mistake transfer it to some other account, so that is called as the operation risk. Even some fraudulent employees also are there, right? So recently, if you see in ICICI Bank, a branch manager, she had misused the funds. So that all is an operational risk. So all these risks should be covered by the banks if it occurs in the future. So that assessment is done by the RBI. Next, it established prudential norms, capital adequacy requirement, and risk management guidelines to ensure that the financial institution have robust risk mitigation measures. Next, crisis management. So it acts as a last lender. Okay, last resort lender. That is, if the banks require money, they can, if that is the last option they can use. That is, RBI can provide money to the banks who are in trouble. So to provide liquidity support during the periods of financial stress, facilitate the resolution of troubled banks, and coordinate with the other regulatory bodies. So this acts as a lender of last resort. Next, role in government debt management. Here we know that you must have heard about treasury bills, right? So who is the treasury bills? If you see, the money that is invested in the treasury bills, that goes to the government of India. But who issues the treasury bills? It is the RBI, that is Reserve Bank of India. They only issue these treasury bills on behalf of the government of India. So government of India itself does not involve in the issuing, collecting money and all. Everything is taken care by the Reserve Bank of India. So the Reserve Bank of India acts as the issuer, regulator and the manager of the government securities. So basically the government of India will tell, I require this much of money. So it is the RBI which issues the treasury bills. It is the RBI which sets the yield rate. Yield rate is nothing but the interest rate. When you issue a bill, when you issue a bond, the investor will expect some interest in return, right? So the interest rate, the yield rate, everything is set by the Reserve Bank of India. Okay. Public debt management. So the RBI formulates strategies and implement measures for efficient public debt management also. So apart from issuing treasury bills, even the efficient management of public debt management is taken care by the Reserve Bank of India. So if you see, effectively managing the government debt, the RBI contributes to maintaining the fiscal discipline, managing the inflation and creating a conducive environment. So the physical discipline also, RBI is very helpful for that purpose also. Because when the required, if you see, if the government wants, say 100 crores, okay, and the interest rate that it is willing to pay for that is say 9%. But if RBI is able to raise or mobilize this 100 crores with just 7% of interest rate, then obviously it is getting our government of India expense will decrease, right? So this in turn will help in the physical management, right? So this is also helped by the Reserve Bank of India. Next, evolving role of RBI. So if you see RBI's function, first it started with currency management. Next, if you see it went with forex management. Next, if you see with digital management and also the financial stability management. So it kept evolving. That is multiple objectives, not just one. So now the main objective, if you see price stability, growth, everything together, it has to be managed by the Reserve Bank of India. So now we have some 15 to 20, 12 to 10 functions. In future, a few more functions may be added depending upon the environment. Next, enhanced risk management. So the risk management also keeps evolving. So previously, if you see in the Basel Norm 1 and all, if you see, there were only 2 types of risk covered. In Basel Norm 2, another risk got added. So the risk gets increasing. As the environment evolves, the risk gets increasing, and so will the RBI norms also, depending upon the risk. Next, technology disruption and governance and accountability. So technology disruption, if you see now and all, majority of the banks or even the fintech companies, they are acquiring customers through the technology. So it is very important that the RBI strengthens the IT guidelines. So if you see recently, even the Kotak Mahindra Bank, the RBI had told the Kotak Mahindra Bank not to onboard any customers through its application or through its website, right? That is because it did not adhere to the latest IT guidelines, the latest cyber security norms. So RBI ensures that no technology disruption happens, ensures that they adhere to the latest IT norms or IT guidelines or latest cyber security guidelines. That is also ensured by the Reserve Bank of India. And governance and accountability, if you see, RBI itself ensures that it is accountable for its action. That is why it tries to bring as much as transparency as possible and strengthening the governance mechanism so that the banks are also equally transparent. So with this, we complete the RBI part 5 also. So we have covered the RBI in detail. I hope you have understood each and everything.